A very good morning, friends. I hope you're all doing well. And most importantly, I guess you've made a cumulative revision of the standard going on. To remind you, we were studying Ind AS 103, and we have already spent a couple of hours, I would say, on Ind AS 103. And we were working on a 7-step model as far as acquisition accounting is concerned. Now, just to remind you, these 7 steps, we are done with the 3 steps. And today we're going to work upon the 4th step, which is a very crucial step from the practical question point of view, that is calculating what we technically call it as a consideration transferred, but commonly we also call it as a purchase consideration. So to remind you that we are working on a 7-step model when you identify that it is a case of acquisition accounting. I'm yet to discuss the concept of reverse acquisition or the concept of a common control transaction, which is addressed in the Appendix B and C of the standard respectively. So I think just as a part of the warm-up exercise, let's recall what were the 7 steps as far as acquisition accounting is concerned. So once you identify that it is a case of acquisition accounting, we need to follow the 7 steps in a sequential order. And the step number 1, which I gave you, is identifying the accounting acquirer. Just to remind you the key aspects without getting into much details at this moment. So I had given you basically that there are 2 factors which would, decide who is the accounting acquirer. And mind you, you need to identify the accounting acquirer and not the legal acquirer. So as far as the 2 focus points are concerned, the 2 focus points in this case is, number 1, did we create a new entity or not? The formation of the new entity is a crucial factor in terms of deciding that who is going to be the accounting acquirer. And I also give you the focus that what is the form of purchase consideration. Is it supposed to be cash, primarily in terms of cash, or is it primarily in terms of equity shares? And that would be the deciding factor. So we decided that if the form of payment is cash, it doesn't make a difference whether the new entity is created or not. The entity which pays the cash is supposed to be the accounting acquirer. So that would always be a case of acquisition accounting. But if a new entity is created and the consideration is in equity shares, it is undoubtedly most of the time going to be a reverse acquisition. The entity which issues the shares, the new entity, would not be the accounting acquirer, but one of the existing companies is going to be the accounting acquirer. And if there is no new entity and the consideration is in equity shares, then we decided in this particular case that you need to calculate a percentage and take a decision. So that was the crux in terms of step 1. Then I took it further and I went to the step number 2, and we said you need to get the date of acquisition. And the date of acquisition, we said the focus point is, when do you get a control? So when we were looking in terms of the date of acquisition, the focus point is that when the control is obtained. So when the control is obtained, that represents, you can say, the date of acquisition. And generally, the control, as we said, is obtained when, you can say, the consideration is paid, which is ideally the closing date, when the PC is discharged. So when the purchase consideration is discharged, we can say that is what we call technically a closing date, which is also the date of acquisition as well. But there could be exceptions we saw where the control could pass on to the acquirer, and that could precede the date of consideration paid. But that's possible only when there has been a written agreement to the effect between the acquirer as well as the acquiree. And we saw that if it is subject to an approval, then you need to dig further and see, is it a procedural or is it something which is substantive in nature? So we saw the exceptions also in this particular case. And the exception, as I said, is that you could have a date of acquisition preceding the closing date when the consideration is paid. So we had a detailed discussions and case studies on that. Then I took you to the step number 3, and in terms of the step number 3, I said you need to go in for a total of 2 steps. 2 sub-steps would be required in terms of the step number 3. Every time you are given a tax rate in the question, be careful, there is going to be an application of Ind AS 12. The presence of a tax rate would imply that you need to carry out the deferred tax asset and liability calculations as well. So the moment there is a tax rate which is given in the question, this would trigger in your mind the application of Ind AS 12. And the crucial factors, what you need to keep in mind is, you could just concentrate on those assets and liability whose fair value, which is going to be the carrying amount, differs from a tax base. Make a list of all those assets and liability in which the fair value, which is the carrying amount, and the tax base is going to be different. And you need to remember that when we are looking at the net assets other than goodwill, so when you're looking at net assets other than goodwill, you are required to create a DTL or a DTA as the case may be. So all the assets and liability other than goodwill resulting in a deferred tax asset or a deferred tax liability would get recognized. And then when you're looking at a goodwill, we already know that as per Ind AS 12, if there is a goodwill which results in a DTL, that cannot be recognized. But if there is a DTA arising on a goodwill, that would of course be taken. So do your calculations on Ind AS 12 in a step number 3 before you go to the step number 3B, making a list of net assets. Then the focus in terms of the step number 3B was making a list of net assets. And we did a detailed discussion on that. That as a thumb rule, when you're considering the list of the net assets, you need to get everything at a fair value as a thumb rule. So when the list of the net assets is being done, the focus is that we need to consider the fair value of all the assets and liabilities which have been taken over. But we saw a couple of exceptions in this particular case, a total of 8 exceptions, out of which we've discussed almost like 3, and a few we're going to discuss later, and few I just give you some basic insights. So we also covered the case of exceptions out here. And if you recall the exceptions which we discussed in the previous class, these exceptions were one in the recognition criteria. That means certain assets and liabilities could be there which are not in the acquiree's balance sheet, but they do find a place in the acquisition accounting entry. And the exception is in terms of contingent liability. And then we saw there could be certain exceptions where the items are already in the balance sheet of the acquiring company, but they are taken in the acquisition entry, not at a fair value. So those were the measurement exceptions. And then we also had a third category of exceptions where the items are not in the balance sheet of the acquiree and they still become a part of the acquisition accounting entry, and in which particular case other than a fair value. So we did a total of 8 exceptions. I gave you a list of total 8 exceptions, out of which we covered in detail contingent liability, and we covered indemnification assets. And of course, the income tax gets taken care in step number 3A. So these were certain exceptions, and then there was non-current assets held for sale, then there is employee benefits, etc. So this is the journey so far in terms of the step number 3. So we have covered these 3 steps with you so far. Now, today I'm going to concentrate on step number 4. So that was a quick warm-up exercise. And I think, let me see if any questions coming in between, and then we can take the journey forward. A very good morning, friends, once again. And yes, revised as well. That's great. We've done accounting acquirer in case of hybrid PC. We've done accounting acquirer in case of hybrid PC. I didn't really get that, Kaushik. You mean to say a purchase consideration is something which I'm yet to discuss today. Okay. So let's take the journey forward, friends. And I am now going to take you to the step number 4. So now this is a very crucial step. and we are going to work deeply on this particular step. Now, when I look at the concept of step number 4, the focus is on the calculation of what we call consideration trustworthy. Technically speaking, we call it as a consideration trustworthy. But commonly, we call it as a purchase consideration, because we're quite used to the term purchase consideration since intermediate days. So I think let's call it as a purchase consideration. But technically, if you look at the standard, it calls it as a consideration trustworthy. But you can use the word PC and a consideration trustworthy interchangeably. Now, let's get the focus very, very clear. Based on the couple of questions which are there in the exams, based on the standard guidance which is given in 103, I identified that there are a total of 7 typical issues which you could confront in terms of purchase consideration. First of all, I would say that when you calculate a consideration, generally, you would see the consideration is either in cash or the consideration is in the form of equity shares. So these are mainly, you can say, the forms of purchase consideration. The acquirer would pay to the acquiring company cash, the shareholders of acquiring company cash, or they would issue equity shares to the shareholders of the acquiring company. So as far as cash is concerned, yes, it would be taken as a part of the PC. And when you take the equity shares, we will take the equity shares at a fair value. So we would consider what is the fair value of the equity shares issued to the acquiring company's shareholder. Just take the sum total of these two and basically you will get a purchase consideration. That's it. So in a very simple question, you can say what we need to do is we just need to add up 2 things: the cash given to the shareholders of acquiring, 1, and the fair value of the equity shares given to the shareholders of the acquiring company, 2. That's it. But as I said, now there will be certain special issues which you're going to confront. So I am giving you a list of 7 special issues which we are going to discuss one by one. So when I'm looking at the purchase consideration, I have, created a list of 7 issues. Number 1, the first one is what I call DC. This is for easy remembrance. I call it as a DC. This is called deferred consideration. So this is what we call a deferred consideration, that is DC. Then the second one is what I call, and the third one is what I call CC. So it's a very easy way of, keeping that list in mind, that there is a DC, then there is a CC. Now, this CC is what we call contingent consideration. This is called contingent consideration. And this CC is also contingent consideration, but the difference between the point number 2 and 3 is that I would first of all also make an evaluation that this contingent consideration, is it paid in the capacity? When it is being paid to the shareholders of the acquiring company, is it paid in the capacity of a shareholder? Is it paid in the capacity of the shareholder, or is it paid in the capacity of the employee? So we didn't get this. That is it paid in the capacity of the shareholder or employee? What do you mean by this? Well, I would say sometimes, though we'll discuss this in detail later, but sometimes you would see that the shareholder of the acquiring company is also the employee of the acquiring company. Mind the words. You would see that a shareholder of the acquiring company is also an employee of the acquiring company. And we may make a payment and we need to evaluate that this payment which is made, is it made to them in the capacity of the shareholder? If yes, it's a part of the purchase consideration. But if you pay this in the capacity of the employee, then it's not a part of the purchase consideration. So evaluating that the contingent consideration is paid in which capacity is going to be an important element. The moment it is paid in the capacity of the shareholder, it's taken as a part of the PC. But if it is paid in the capacity of the employee, it's not going to be taken as a part of the purchase consideration. Now, the nitty-gritties, of course, we'll discuss very shortly. Then number 4, the fourth agenda is what I call TC. I've just given these nicknames, for the ease of convenience so that it's easy to remember. DC, CCS, CCE, and then we've got a TC. So out of the 7, 4 is easy to remember. So this TC is what we call is a transaction cost. Now, when we incur any kind of transaction cost, let me tell you outrightly that any kind of transaction cost which is paid at the time of acquisition is simply considered to be a revenue expenditure. Like, for example, if a company purchases a PPE, or let's say if a company purchases an intangible asset and you're covered under Ind AS 16, or if you're covered under Ind AS 38, then any kind of transaction cost gets capitalized. So if, let's say, for example, you paid a brokerage, or if you paid a commission in terms of the deal, and the machinery was bought on a standalone basis, the commission which is paid is directly attributable, and it would get capitalized as a part of the cost of the asset. But when it is acquisition accounting, a case of business combination, any kind of transaction cost which is paid is considered to be completely revenue in nature. You cannot capitalize it as a part of the net assets acquired. So I would say, as far as TC is concerned, it's not taken as a part of the purchase consideration. The TC is simply treated as a revenue expenditure. It is going to be treated simply as a revenue expenditure, simple, not a part of the purchase consideration. So in the question, if you're given information on a TC, today I'm going to give you a feel of a simple question on acquisition accounting as well. After we're done with the calculations of PC, goodwill and NCI as well, let's see, if you get time, we will definitely come to a small question. Then after this, we've got the next special issue, and that is what I call PHI. You heard this term from me earlier as well. When we were looking at the concept of, the concentration test, I used the concept of PHI as well, which is called a previously held interest. It is called a previously held interest. So there could be a possibility that as far as the acquirer is concerned, he may already have a stake in the acquiring company. Because let's say there could be 2 possibilities which could arise. You were a passive investor where you had a less than 20% stake in the acquiry, and then you acquired another stake, and that converted from a passive investment to a case of control. So this is also what we technically call it as step acquisitions. This is also what we call it as a step acquisition, and this is a very important area. Because you could expect an independent questions on the concept of step acquisitions as well. So there has been, a question on, a little lesser of Ind AS 103, but typically a questions on the concept of previously held interest. The previously held interest could be 2 cases, as I said. You were a passive investor below 20%, then you acquire a further stake converting to control. Or the other case could be that you had a significant influence that is 20% or more than 20%, and then you acquired a further stake, converting it into a control situation. So we need to see that if there is any previously held interest, then how do you tackle that as a part of the purchase consideration? Next, the 6th agenda is what we call SBP. And I think the name itself is quite indicative that I'm looking at a share-based payment. Wow. Do you remember when I did the step number 3B, I gave you that one of the exceptions is a share-based payments, and I said I'm going to discuss that in step number 4. So there is something which we need to discuss as a part of the PC, that is called share-based payment. Now, what exactly is the concept? That we'll discuss in detail later. So you can see the list of 6 issues so far. There is a DC, there is a CCS, there is a CCE, there is a TC, then there is PHI, and there is SBP. Not difficult to remember. So, when you're cracking a bigger kind of a question, you need to keep these factors in mind. And then we've got a 7th agenda as well. And the seventh agenda is what we call pre-existing relationship. The seventh agenda is what we call a pre-existing relationship. Now, as far as a pre-existing relationship is concerned, in terms of a pre-existing relationship, it is possible that before the control is acquired, the acquirer and the acquiree had some kind of dealings with each other, either in the form of a contractual relationship or in the form of a non-contractual relationship. So this pre-existing relationship will also have an impact on the calculation of the purchase consideration. So this is a list of the 7 special issues which we need to keep in mind when we calculate a purchase consideration. Looks quite comprehensive. If you recall your concept of purchase consideration in Accounting Standard 14, what you did in intermediate was pretty simple and pretty straight indeed. But I think now if you look at, it's got a little complex, but trust me, this 7 agendas at the back of the mind, you can easily handle a bigger question very easily, provided you've got your expertise in terms of the 7 agenda. So what I'm going to do, I'm going to make you an expert on the area, and we're going to discuss each of these 7 issues one by one, supported with a lot of questions for each one of them, so that you get a good hang on things. But I think you would have already got a thought process clear. So this is my chain of thought. This is my chain of thought as I take you forward to the step number 4. Step number 5 and 6 is not very technical indeed. So the main crucial step is the step number 4, the calculation of the PC, right? I don't think so there would be any questions coming so far to your mind, I guess. And I think let's take the journey forward. Yes, there are no questions so far. So let's begin one by one. So what I'm going to do, I'm going to first of all cover these 3 issues together. I'm going to discuss DC, CC, and SCCS and CCE together, and I'm going to give you a wonderful 3-step model with which you will easily be able to identify that what is it a DC, is it a CCS, is it a CCE, and you would also be able to get the inputs, what is the value at which it is taken as a part of the PC. So let's take it further. Now, my focus is discussing the concept of DC, CCS, and CCE. So I'm discussing 3 special issues together, and then we'll do some questions also with you. I've generally seen, people tend to get confused in terms of a deferred consideration and in terms of contingent consideration. Is this DC? Is this a CC? Now, let me first of all tell you one very important agenda before I give you a 3-step model on this. When I look at a deferred consideration, it is something which will be paid in future. When we look at the concept of a deferred consideration, it is something which is going to be paid in the future. But what is important is that it will definitely be paid. The acquirer company told the shareholders of the acquiring company that I will pay you this amount in another 2 years' time. I'm going to pay this amount in another 1 year's, 3 years' time, whatever. So this is an amount which is paid in future, but is going to be paid 100%. There is a 100% surety that the amount will be paid. So when you look at a question, you need to be very careful that this amount is relating to the future. It's going to be paid in the future without any ifs and buts. So in this particular case, you can say you will not find any ifs and buts in this particular case. No conditions will be attached to this payment. It is something which is bound to be paid at a future date. So the standard makes it very clear that when you consider the purchase consideration, in this particular case, the deferred consideration is to be taken at a fair value as a part of the PC. Now, when I say it's taken at a fair value, you need to basically take a present value of that future amount. So the question would give you a discount rate for the purpose. It'll be very clearly given to you that what is a discount rate, and we will just take the present value of that future amount, and that is taken as a part of the PC. The present value of that future amount is called a fair value. So when it comes to a deferred consideration, you need to be careful. It is something which is paid in the future for sure without any ifs and buts. And you need to take it at a fair value, which is at the present value of the future payments. Next. If you look at the concept of a contingent consideration, the concept of contingent consideration is, again, you can say something which is going to be paid in future. As the word is suggestive that this is contingent. When I say contingent, it means it is dependent upon certain ifs and buts. The common thing between a DC and a CC is that the payment is going to be made in the future. But what is the difference is that when you look at a DC, it is a payment in the future without any ifs and buts. And if you look at the concept of CC, it is a payment with some ifs and buts that, okay, if this happens, I make a payment. If this doesn't happen, I don't make the payment. So in this particular case, it is something which is dependent. It is something which is dependent. That means it is based on ifs and buts. So that is the thin line of distinction, that the common thing is paid in the future. But what is the difference is no ifs and buts means DC. Ifs and buts would mean that this is a CC. The question will very clearly tell you that this amount is going to be paid if this parameter is met. So once it is dependent upon those ifs and buts, it is clearly indicative that it is a contingent consideration. Next. The next question what comes to the mind is that how would I decide that it is paid in the shareholder's capacity or is it paid in the employee's capacity? Now, this is simple. You need to see that the condition which has been attached, the parameter which is being attached, does it mean that there is any kind of a service condition? Is the acquirer company asking the acquiring company's employee shareholder? I'm saying employee shareholder because this fellow, could be employee as well as a shareholder of the acquiring company. So you need to put across a question to yourself that is there any service condition? Did the acquirer company tell the employee shareholder of the acquiring company that you need to put in a service? If the service condition is a yes, this means the payment is in the employee's capacity. It is in the employee's capacity, and then it's not taken as a part of the PC. Then it's not taken as a part of the PC. But if you say, no, there is no service condition, but there may be conditions other than service. The conditions are there, but the condition is not a service condition. Then it is in the capacity of a shareholder and it is taken as a part of the PC. Then it is taken as a part of the PC and it's going to be taken at a fair value. And that fair value will, of course, be given in the question. So this would definitely be given in the question. Now, friends, a very important agenda. And the important agenda is that when I'm looking at DC, CC, shareholder or employee capacity, you need to know two things. You need to know the role of these elements at the time of acquisition accounting. You also need to know how would you tackle these things post-business combination. Because many people are very clear with the thoughts that, okay, DC is a part of PC at a fair value. CC in the shareholder's capacity is a part of the PC at a fair value. CC paid in the employee capacity is not a part of the PC. We all know this very well. But you should also know that this is the role at acquisition date. What happens post-business combination? How do you treat a deferred consideration in the books of accounts after the business combination? Because if you're going to get an independent question on a deferred consideration or an independent question on a contingent consideration, we need to be very careful and clear that what is the accounting subsequently as well. So what I'm going to do, I'm also going to give you the inputs, what is to be done at a subsequent level. So we need to consider what is the accounting at acquisition date for each of these 7 special issues, and what is the accounting of each of these components post the business combination as well. Okay. But before that, I think let's create a simple 3-step model which I've created for the ease of convenience so that you can easily decide DC, CCE, CCS, whatever the case might be. So let's give you an interesting chart. So I'm going to first of all take you to the interesting chart on this. And I'm giving you a simple 3-step model. I've created this for the ease of convenience. And let's take a 3-step model so that when you do a larger question, there are no challenges in life. So in this particular case, this is a 3-step model applicable to DC, CCS, and CCE, that is contingent consideration shareholder capacity, contingent consideration employee capacity. Okay, so let's begin with the step number 1. Well, I would say at the first step, you got to ask yourself, is the payment to be made, in future? So the focus point is that, is the payment going to be made in the future? So you got to first of all ask yourself a question, that is this payment going to be made in the future? And the answer would be either a yes, or the answer could either be a no. Now, if you say no, the payment is not in the future, it cannot be a deferred consideration. Neither it can be a contingent consideration for sure. Because unless the payment relates to the future, something which is going to be paid at a later date, not on the date of acquisition, it cannot be a DC or a CC. If you say a yes, it can be a DC or it can be a CC. So for this, we're going to go to the step number 2. So one thing is confirmed, that it is definitely a case of a DC or a CC. Focus, payment in the future. Then we go on to the step number 2. And in terms of the step number 2, you are going to look at, is there any ifs and buts? So I'm going to ask myself a question, that is there any ifs and buts? That is the focus point. That is there any ifs and buts? In simple words, that there are any conditions attached to the payment. So you need to see that if there is any ifs and buts, are there any conditions attached to the payment? And in this particular case, the answer could be again a yes or no. The answer could again be a yes or a no. If you say no, there are no ifs and buts, I think we've decided it is a deferred consideration. So the moment you say that there are no ifs and buts in this particular case, we have decided it is undoubtedly a deferred consideration, and which is a part of PC. It is a part of PC at a fair value, which is supposed to be that you need to consider the present value. So in this particular case, it's a deferred consideration to be taken as a part of the purchase consideration at a fair value, which means take a present value. Okay, if you say that there are ifs and buts, yes, then we've decided it is a CC, and I'm going to go to the step number 3. Because we now need to decide in what capacity it is paid. So we're going to go to the step number 3. That makes life simple. The focus is future. The focus is ifs and buts. And then we go on to the step number 3. And in terms of the step number 3, what I'm going to do, I'm going to see that is the condition requiring service? It is requiring service, so that is the key focus. So is the condition requiring service by employee shareholder? Is it requiring a service by the employee shareholder? Because this payment is given to the, you can say, person who is not only a shareholder of the equity, but also an employee as well. So we need to see, is the condition requiring a service or not? And the answer would either be a yes, or the answer would be a no. Now, the moment you say that yes, it requires a service condition, you tell the person that you need to put in some service to, get this money. So in this particular case, it is CC in employee capacity, and this is not part of PC. This is not a part of the purchase consideration. So how are you going to tackle this? You're going to apply Ind AS 102 to this payment. because it is a payment which is dependent upon service conditions. So this is a case where it is to be accounted under Ind AS 102. So in this particular case, you need to apply Ind AS 102, and it's not a case of purchase consideration. But if you get the answer, no, there is no service condition, then it is in the shareholder's capacity, and this will be a part of purchase consideration. And this will again be taken at a fair value, which is going to be given in the question. So we will take this as a part of the PC, and that would be at a fair value. I guess that should make the life very simple, not a heavy technical concept at all. So just remember the simple three-step model, which is going to take care of the three special issue, CC, CCS, and a CCE. The focus is the payment in future? Are there any ifs and buts? And the focus is any service condition or not. DC, part of PC at a fair value, present value. CCS, part of the consideration fair value. And CCE is not to be taken as a part of the PC. You got to apply Ind AS 102. Okay. Before we go to any questions on this area with you, I guess I've got a question, Amrita. CEO is an employee of the company or not? Well, I think you just need to see that is this fellow also the shareholder of the company or not? I think the designation of the employee would not make a difference. We just need to consider in this particular case that when you make a payment, the payment is made to a fellow who is both an employee as well as a shareholder of the company. So designation is not important for me. I'm basically going to look at the fact that is he getting a payment that you serve me for certain years, then I give you a payment. Then the service condition means not paid in the capacity of the shareholder. So that's the important bit. Okay. So now let's take it further. Before I do the practical, questions with you on this, as I said, you need to be also clear with the concept of the subsequent accounting of these components as well. So I'm going to make a wonderful chart, which will tell you the insights in terms of that if there is a DC or a CCS or a CCE, what is the accounting in a post-business combination period? Now let's have a look at this clarification chart. So I'm going to make a very interesting chart, which will summarize the position, and then we'll do some questions with you on this area. So let me, I think, first of all, create a simple chart. Let's take a few rows and columns. So let's take the case of one column, and then we're looking at the initial and the subsequent accounting as well. Okay, so let's divide this in three parts. Now watch this carefully. This chart is going to give you a lot of clarity of thoughts. So I'm taking the first column as particulars, and I'm taking this at the date of acquisition, and I'm taking this post-business combination. Now watch this carefully, because this is something we need to know, because generally if you get independent questions on these concepts, the examiner would be interested in testing your knowledge regarding the treatment of these elements post-business combination. So I'm looking at number one, DC. I'm looking at number two, CC, that is S. And I'm looking at the third one, that is CC, that is E. Now, let's consider this very carefully in terms of what is to be done. Well, if there is a deferred consideration, we've already said very clearly that in this particular case, we will take it as a part of PC. We will take it as a part of the PC at a fair value. So that guidance I've already given you. Now the question arises that this deferred consideration, is it going to appear in the balance sheet of the acquirer as well? Of course, yes. The payment is something which is yet to be made. So in this particular case, we can say that this is undoubtedly a financial liability. You can say under the purview of. This is undoubtedly a case of a financial liability, and you can say under the purview of financial instruments, because this is something which is you have to pay. There is a contractual obligation of the acquirer to pay this money. It's an unavoidable contractual obligation which you need to pay. So the interesting part is when you took this took it as a part value. The fair value means you took a present value. And you would know by now, and trust me, I'm going to make a strong statement applicable for entire Ind AS. Whenever you consider the concept of time value of money and you land up considering a present value concept, it always leads to an unwinding of discount in the future. It always leads to the concept of UOD. For example, you would recall if you purchase inventory on a deferred credit, or for example, if you purchase a PPE or intangible assets on a deferred credit, then you also consider unwinding of discount. For example, if you consider a decommissioning liability in Ind AS 16 or a PPE, you again apply the concept of unwinding of discount. For example, when you consider a provisions in Ind AS 37 and you consider that the time value money is material and you apply a present value concept, you do an unwinding of discount. So keep that in mind, that when in Ind AS you are looking at a present value, you're looking at a time value money. So one thing is very clear, that in a post-business combination, it will definitely lead to UOD, that is unwinding of discount. It will definitely lead to the concept of what we can say unwinding of discount. So we are going to consider the finance charge in the future. So in an independent question, the examiner may ask you to give you the accounting treatment, for the post-business combination as well. So I need to know that I am going to pass an entry in the post-business combination period, and the entry is finance charge will be given a debit. And you can say the deferred consideration will be given a credit. So this would lead to unwinding of discount. So this is what we need to know, that if you consider the DC as of today as a part of the PC, the DC needs to be unwinded. So you need to attribute a finance charge at a future date. That is one. Second, if you look at the concept of a contingent consideration in a shareholder's capacity, we said, yes, it is again a part of the purchase consideration, and this is also being taken at a fair value. So this is also going to be taken at a fair value. But now the question arises that this contingent consideration, is it supposed to be a financial liability or is it supposed to be an equity instrument? Wow. So I would say in this particular case, you will have to see that the contingent consideration, is it being paid in cash? Because you would remember, in terms of financial instrument, the mode of payment. The mode of payment is a vital element to decide that the amount is a financial liability or is it supposed to be an equity instrument. Because generally, when a company discharges an obligation, it could either pay cash or it could use equity shares as a currency note. So you need to focus that this contingent consideration is being paid in what form? Are you making a payment in cash or are you making a payment in terms of equity shares? You concentrate on the mode of payment, that this money which you're planning to pay, is it going to be paid in cash or is it going to be paid in terms of equity shares? If the mode of payment is cash, I would say it is undoubtedly a financial liability. It is undoubtedly a financial liability. And if it is paid in equity shares, then you need to apply a fixed test. You know that when in terms of Ind AS 32, in terms of financial instruments, if your mode of payment is equity shares, you know that there are two kinds of tests. One is if there is a non-derivative contract, you apply a fixed test. And if it is supposed to be a derivative contract, you apply a fixed test in order to evaluate whether it's a financial liability or is it equity instrument. Considering that this contingent consideration is something which is non-derivative in nature, generally would be non-derivative in nature. So in this particular case, you will have to apply the fixed test in this particular case. You will have to see that the number of shares which are being issued is fixed or variable in number. So we'll have to make an evaluation on the fixed test, and if the number of shares is supposed to be fixed, then it becomes an equity instrument, and if the number is supposed to be variable, it becomes a financial liability. So get the focus very clear that when you are looking at a contingent consideration, the contingent consideration, you need to be careful on the form of the payment. Is the contingent consideration going to be paid in cash? Then it is undoubtedly a financial liability. If the contingent consideration is paid in the form of equity shares, you need to apply a fixed test as per Ind AS 32 and see the number of shares which are going to be issued as fixed or variable in number. If the number of shares is going to be fixed in this particular case, we can say it is an equity instrument. But if the number of shares to be issued is variable, then it is a financial liability. So this is one thing what you did on the date of acquisition. You took to focus what is it to be taken as a part of the PC or not, and what is the status? Is it a financial liability or otherwise? Here also, is it to be taken as a part of the PC, and what is the status in terms of the balance sheet presentation? Then comes the question, what do you do on a subsequent accounting? Follow the concept of Ind AS 32 in this particular case. If you say that the payment is made in terms of cash and it is supposed to be a financial liability, you know that the financial liability in this particular case is going to be measured at FVTPL. So I'm not saying that it cannot be at amortized cost, but generally, oh no, it cannot be AC. You know, if you remember financial liability concept, the definition of financial liability in terms of Ind AS 32 very clearly defines that the contingent consideration which is paid on business combination is a financial liability. If you read the definition of a financial liability, which is given in terms of the standard, not the definition, but there is a more guidance which is given. It very clearly tells you when it talks of the types of financial liability that the contingent consideration paid in a business combination is supposed to be a financial liability which is measured at a fair value through profit and loss account. So it is going to be taken at FVTPL, which means subsequently any changes in fair value, are taken to profit and loss account. So any changes in the fair value is going to be taken in the profit and loss account subsequently. So the same status will go in terms of if the mode of payment is equity shares, then you can say in this case, again, it is an FVTPL concept, and the same concept would apply. So whether the mode of payment is cash or the mode of payment is variable shares, then you need to remeasure the liability at a fair value at each balance sheet date, and the changes in the fair value are to be taken in the profit and loss account. But if you say that this is a payment which is in fixed number of shares, then it is an equity instrument. And you know that as per Ind AS 32, there is no remeasurements which are done in terms of equity instruments. So in this case, no remeasurements will be done. In this particular case, we can say no remeasurements will be done in this particular case. Right, friends. So I think I made myself very clear. Let me just quickly consolidate the picture before we take you to more questions on this area. So the moral of the story. The moral of the story in this particular case is the focus is on three elements of purchase consideration: DC, CCS, and a CCE. I'm yet to discuss CCE, but I think let me just quickly put it down. If you say contingent consideration is paid in the employee capacity, it's not a part of PC. It's not a part of the purchase consideration. So what do you do subsequently? You basically apply Ind AS 102, which talks about share-based payment. So it is going to be accounted completely under Ind AS 102. Now, let's get the position very clear. The most important aspect of this particular Ind AS is there is a lot of things to be, kept in mind. But trust me, if you keep doing a cumulative revision and you keep those factors in mind, I don't see a possibility of going wrong in the exams. You need to be just very crystal clear on, what you need to do at each and every stage. And trust me, it's simple. It's simple. And that's the reason I'm making, the step-by-step things. I'm making these clarification charts so that, when you do it before the exams, it'll be very easy. Because if you start running and reading papers and papers, it's very difficult, to remember things. And this kind of charts, it gives you a very quick overview of things, and one is able to relate things very easily. Okay, so the focus is that when you consider a DC, it is certainly a part of the purchase consideration at a fair value, and this is a financial liability for the balance sheet perspective. If you look at a CCS, it is again a part of the PC, and whether it's a financial liability or equity instrument depends upon the mode of payment. If the mode of payment in terms of CC is a cash, it's financial liability. And if it is supposed to be a mode of payment equity share, it all depends upon the fixed test, because you need to go back to Index 32. And in this particular case, if fixed shares are going to be issued, it is equity instrument. If the number of shares issued is variable, it's a financial liability. There is a very interesting question in the study material, which is also there in the educational material, and it contains the independent question on accounting for CC. And then we said, if it is CCE, it's not a part of PC. So this is the focus, what do you do on acquisition date? So two things need to be kept very clear in mind. Is it to be taken as a part of PC or not? At what value? And what is the balance sheet presentation? Is it a financial liability or an equity instrument, as the case might be? And then getting that post-business combination, what is the accounting treatment? A DC would mean unwinding of discount. So you need to attribute a finance charge on a subsequent accounting. When you're looking in terms of the contingent consideration, then you need to see that if it is a financial liability, it is undoubtedly measured at a fair value through profit and loss. So any increase or decrease in fair value is going to be taken in the P&L in a subsequent balance sheet dates. And if it is equity instruments, no remeasurements are done. It remains at the same value at which it was initially recorded. And if it is a CCE, then the standard is not applicable. You got to account under share-based payments. And I think TC I've already given you. So I think out of the 7 issues, we're done with the 4 issues. We know DC, we know CCE, we know CCS, and a TC. I guess you should be conceptually sound. Before I take you to the practical illustrations, I want you to give yourself a rating, not me a rating. You need to give yourself a rating on a scale of 10. What is your comfort zone on your conceptual understanding so far? In the meantime, let me take the journey forward. And Koshki, thanks for all such notes. You're most welcome. The pleasure is mine. So give yourself, friends, a comfort rating on a scale of 10, that what is your comfort zone on the conceptual understanding of these 4 issues so far. So in the meantime, let me take you to some questions now on this. So I've just added a few questions in the assignment, which of course will be shared to you. And let me take it further. So let's do some practical questions with you now at this particular stage. Let's have a look at the concept of a deferred consideration. Okay, I think Koshki tells me a 10 by 10. Namrata tells me a 7 out of 10. That's great indeed. Okay, so I think once we do the questions, the rating is going to go definitely up. That much I can assure you. So because whenever we need a little better understanding, doing questions is very important, because only with that we are able to get a more hang on things. Okay, so let's have a look, friends, with you. I'm looking at a question number 12, and let's have a look at the question number 12. And this is on a deferred consideration. So let me just take you to the question. Let me read it through, and then we take it further. It says ABC acquired the entire equity share capital of PQR. It's 100% acquisition with no NCI. And this is acquired for 8 crores. It says ABC paid 2 crores in cash, and the balance 6 crore is being agreed to be paid to the seller in 5 years as a deferred consideration. I don't need to decide that is it a DC or not. It's very clearly given that out of a total of 8 crores consideration, 2 crores is going to be paid right now in cash, and the balance 6 crores is going to be paid in a 5 years time. So this is something which is going to be paid in the future. How should the deferred consideration be valued for determining the consideration transferred in relation to the computation of goodwill? Well, in this case, I'm not given a discounting rate. So let me just assume, let's say a 10%. So if somebody would ask me to calculate a purchase consideration, I would say you can take the sum total of 2 crores as it is. This is what you're going to pay right now. And the remaining 6 crores, which you're going to pay after a period of 5 years, if I take a 10% discounting rate, then you could discount this at 10% for a period of 5 years. Simple and straight. And that will give you the amount of purchase consideration. As simple as that. So the moment you're given a deferred consideration, we need to apply the concept of present value, which will give us a fair value. So I'm assuming a 10% discount rate, not given in the question. So 10% for a period of 5 years. Simple. Okay, this was a question on a DC. Now let's have a look at a few interesting questions on contingent consideration, where we need to watch out that is this a case of a CC, which is supposed to be S, or a CCE, as the case might be. Let me zoom it slightly further. So we're going to watch the question and we're going to decide in this particular case, is it a case of a CCE or a CCS? Remember the 3-step model which I gave you, just keep that in mind. It says KKV acquires a 100% stake in Viva. So it's a 100% acquisition with no NCI. A company is owned by a single shareholder who is also the KMP in the company. As I said, in most of the questions, you will notice that when a payment is being made, let's say to a person, he would be a shareholder of the acquiree as well as an employee of the acquiree. So we need to evaluate the payment is made to him in the capacity of a shareholder, or is it made in the capacity of the employee? It says the company acquired the company Viva, and he's also a KMP, for a cash payment of 20 million and a contingent payment of $2 million. So 20 million is something which is paid right now, and 2 million is something which is very clearly said it's contingent. And the terms of the agreement provide for a payment 2 years after the acquisition. So one thing is very clear. The payment is in the future, undoubtedly, and it is dependent upon certain conditions. It is contingent. The only thing to be decided is that is it based on a shareholder or employee capacity. So it says if the following conditions are met, so there are ifs and buts. It says the EBITDA margins of the company after 2 years is 21%. The condition is that the EBITDA margin is going to reach 21%. The former shareholder continues to be employed with Viva for at least 2 years after the acquisition. So there is a service condition which requires you to serve the company for the next 2 years. No part of the contingent payment will be made if the former shareholder does not complete the 2 years employment. I don't think so. I need to really tell you the answer. I think if your conceptual clarity is clear, you would be able to answer this very quickly. That in this particular case, the service condition is there. So what is the treatment of this? Is this going to be taken as a part of the purchase consideration? Are you making a payment to the shareholder in the capacity of the shareholder or in the capacity of the employee? I think it's very clear. It's paid in the capacity of the employee. I think I would easily get your answers on that. That's rightly said. It is CCE. That's wonderful indeed. So in this particular case, we can undoubtedly say that it's not a part of the purchase consideration. It is a contingent consideration in employee's capacity. So therefore, the accounting under Ind AS 102 is going to apply. Okay, that's wonderful indeed. This was a question which is there in the study material as well. Let's take you to another question. Let's have a look at the question number 14. Now, in terms of the question number 14, I am given that ABC acquires all the outstanding shares of XYZ. It's again 100% acquisition, which means that there is no NCI in this particular case. Now, you would say, sir, is the presence of the NCI going to make any difference on the analysis? No, no, no. So even if you acquire 100% equity or less than 100%, that would not make a difference. The presence of NCI is not going to make any changes to the analysis. Okay, let's read further. It says ABC acquires all the outstanding shares in a business combination. XYZ had three shareholders with equal shareholding, and two of whom are also senior level employees of the company. So there are three shareholders, but only two of them are also employees. So one of them is just a shareholder. One of them is just a shareholder, and two are both employee and the shareholders of the company. And it says Anne would continue as employee post acquisition of shares. It says the employee shareholder, we're looking at the shareholders who are also employee, they will receive 60 lakhs plus an additional payment of 150 lakhs to 200 lakhs based on multiple of earnings over the next 2 years. And the non-employee shareholders, the focus is non-employee, is going to receive 100 lakhs each. So the employee shareholders are getting a payment of 60 lakhs today, and they're going to get another payment which might range between 150 to 200 lakhs, and that is based on a multiple of earnings. There is no service condition, as we can see. The non-employee shareholder receives a total of 100 lakhs. Now, let's see further. It says the additional payment of each of these employees. So we're looking at that 150 to 200 lakhs payment, which is the additional payment to each of the employee shareholders will be forfeited if they leave the employment at any time. Now he's made it very clear that apart from the fact that it is dependent upon the earnings, this money will be forfeited if they leave employment at any time during the period of 2 years following the acquisition. The salary received by them is considered reasonable remuneration for the services. How much amount is attributable to post-business combination services? I think, again, I don't need to tell you that this is undoubtedly a case of contingent consideration. It's a future payment to be made 2 years later, and it is contingent on ifs and buts. So we need to see that it is CCE or a CCS. I think you can decide that very well. The payment of 150 to 200 lakhs is contingent upon that if you work for 2 years, I give this to you. If you don't work for 2 years, I don't give it to you. So I think your answer would be there. It should be CCE. Wonderful indeed. That's right, Amrita. It becomes a case where you can say Ind AS 102 is going to be applicable. So here again, we can very clearly say that the answer to this question and the answer to both the questions is same. The additional payment. Now, what are you making a payment right now? 60 lakhs is a part of the PC. What are you going to make a payment to the non-employee? 100 lakhs is a part of the PC. 60 lakhs paid to the employee shareholder, 100 lakhs paid to the non-employee shareholders right away, of course, is a part of the PC, but the additional payment is a case of 102. So the entire amount is attributable to post-business combination service. The full amount, which is the additional payment, is going to be attributable to the post-business combination period. Okay, let's take it further. Let's take it further. Let's go to another question with you. And now I'm interested in doing something very interesting indeed. So let's, take you to a wonderful question indeed. Let me just clear this out. So 2 more very interesting questions on this area before we take it further. So let's see the question number 15 to begin with. So let's have a look at the question number 15, and then we'll see question number 16 as well. Okay. Let's come back to the question number 15 now. Try this. It's very simple. It says ABC acquires PQR in September for cash. Additionally, ABC agrees to pay the selling shareholder an amount equivalent to 10% of the profits in excess of 10 crores generated over the next 2 years in cash, in lump sum at the end of 3 years. So we can see that they've agreed to pay the shareholders an amount which is 10% of the profits in excess of 10 crores. So if the company earns a profit more than 10 crores, they're going to get 10% of that excess earning. And this is going to be paid in cash, and it's going to be paid 3 years later. So my focus is getting very clear that it's a future payment on ifs and buts. So it is definitely contingent in nature. ABC determines the fair value of the contingent consideration to be 1 crore on the date of acquisition. A year after the acquisition, the company performed better than initially projected, and a higher payment is now expected at the end of second year, and the fair value of this amount of financial liability is 2.5 crores at the end of the first year. Whether any adjustments in the acquisition accounting is done, if yes, by what amount? Wow. So indirectly, you can see now the focus is, the earlier two questions, the focus was on the acquisition date. What is the status of the contingent consideration at acquisition date? Is it a part of PC or not? Here now, the focus is on a post-business combination accounting. So I think first we need to see that is it a CCS or a CCE? Well, I guess in this particular case, if you notice, is there any service conditions which are there? I guess no. The only condition which is given is that the payment is going to be made if the profits reach a certain level. If the profits are more than 10 crores, you pay 10% of the excess earning to the shareholders. So can I say in this case, you can easily decide it is a case of a CCS. This is a contingent consideration paid in the shareholders' capacity. So do you take it as a part of the PC? Yes. So we can say on the date of acquisition, you're going to take it as a part of the PC. So what is the fair value? The fair value is 1 crore. So this is going to be a part of the purchase consideration at the date of acquisition. What happens on a post-business combination period? Now we need to see that is it a payment in cash or is it a payment in terms of equity shares? And the focus is very clear that this payment is in the form of cash. If it is in the form of cash, and he's also very clearly made it clear that the fair value of this financial liability. So I don't need to even decide, whether it's a financial liability. Since the mode of payment is cash, the question is very clearly telling me that it is a financial liability. Since it is a financial liability, you need to do the post-acquisition accounting at FPTPL. This financial liability is not at amortized cost accounting. Because generally, when you think of financial liability in financial instrument standard, you'll end up saying that it is default measured at amortized cost. But in this particular case, this liability is always FPTPL. So what is the fair value? The fair value is 2.5 crores at the end of the year, which means that you need to take the change in fair value in the profit and loss account. So you can say 1.5 crores is going to be debited to the profit and loss account after 1 year. Since the value of the financial liability enhances, therefore you need to put an entry, profit and loss will be given a debit and the financial liability will be given a credit. So the change in the fair value 1.5 crores gets a hit in the profit and loss account. Simple, right? So this was a case of a mode of payment being cash classified as this. Okay, I think we got all correct answers on that. That's brilliant indeed. Let's take it further. Okay, now I'm coming to the next question with you, which is also a very interesting question. I think this question has got repeated by mistake. 16th is similar to the question we have done earlier. So let's go to another question. So this, I think, page has got repeated in any case. So let me do one thing. Let me just eliminate this, I guess. Okay, so let's show you now a very interesting question indeed. And there is a beautiful question. Let's, I think, do a very interesting question with you. This is a question which has come in mock test papers as well. It's in the study material as well. And I think it's a very interesting question indeed. If you're able to understand this question, then I think the concept of CC is wonderfully done. You can see it's in the education material, it is there in the study material, and it's come in the mock test papers April 18 and in the mock test papers October 19. Quite an important question indeed, got a good frequency. So let's read this question with you. It says, how should contingent consideration payable in relation to business combination be accounted at the initial recognition and at the subsequent measurement in the following cases? The focus is the chart. What is the treatment at initial and post-business combination in this case. Let's read. It says on 1st April 16, A acquires 100% interest in B, so no NCI. As per the terms of the agreement, the purchase consideration is payable in the following two tranches. It says there is an immediate issuance of 10 lakh shares of A with a face value 10. So whatever is being given immediately, of course, is not a DC or a CC. So this 10 lakh shares will be taken at a fair value, not at a face value. That I gave you initially, that generally the consideration could be in cash or it could be in terms of equity shares. So we're going to consider the fair value of the equity shares as a part of the PC. Then he says a further issuance of 2 lakh shares. It is 2 lakh shares after 1 year if the profits before interest and tax for the first year exceeds 1 crore. So a couple of things which you can see, that there is an issuance in terms of shares, and that is after 1 year and if the profit reaches a certain level. So we can see something very clear. Number one is the payment related to the future. Yes, it's a payment after 1 year. Number two, is it dependent upon certain ifs and buts? Yes. But do you see any service condition attached to the payment? Of course not. So we can say that in this particular case, we can undoubtedly say that it is a case where we can say it is a CCS, because it is a payment in the future 1 year, and there is a if and buts, and the ifs and buts do not relate to service condition. So we can say undoubtedly this is a contingent consideration in the shareholder's capacity. I think now let me ask you, this is a payment which is being made in equity shares and 2 lakh number of shares. So what is your input? Is it a financial liability or is it an equity instrument in this case? He's very clear that the further issuance of 2 lakh shares, the number is being predetermined in nature. I think you can easily decide. Since it is a fixed number of shares, it is undoubtedly a case of equity instrument. So we can say that this will be classified as an equity instrument. So any remeasurements will be required on a subsequent date? Of course not. We're going to consider them at a fair value on the acquisition date as a part of the PC, but no remeasurements will be required because it is an equity instrument. I think you would have made the guess correct. And that's absolutely correct. Makes wonderful sense. So let's take it further. So in this particular case, we can say, let me calculate the PC. The fair value of the shares on the date of acquisition is 20 rupees a share. Further, the management estimated on the date of acquisition, the fair value of the contingent consideration is 25 lakh. So what is going to be the amount of purchase consideration? Let's calculate the PC. So we can say, number one, you are issuing 10 lakh shares, and these 10 lakh shares have got a fair value, which is 20 rupees per share. And the contingent consideration is worth 25 lakhs. So if you consider the PC, 200 plus 25, it comes to 225 lakhs. That is the purchase consideration. The fair value of the equity shares issued and the fair value of the contingent consideration that gives you the amount of PC. Any remeasurements to be done at a future date? No. So we can say there is no remeasurements. There is no remeasurements to be done as far as contingent consideration is concerned because it is an equity instrument. Simple, super. Okay, let's take it further. Then he says during the next year, the PBIT exceeded 1 crore and the fair value of the shares is 25 now. Does this mean that I am going to change the fair value of the contingent consideration? No. Because since the contingent consideration in this case is an equity instrument, the updation of the fair value, the change in the fair value is not to be incorporated. Great. Let's go to the part number B. It says, continuing with the fact pattern in A above, except the number of shares to be issued after 1 year is not fixed. If it is not fixed, it means it is variable in nature. And if it is variable in nature, it is a financial liability. And if it is a financial liability, the remeasurements post-business combination is going to be done as well. So the moment the number of shares issued is variable, it is a financial liability and the remeasurement would take place. Rather, A agreed to issue a variable number of shares with a fair value equal to 40 lakhs after 1 year if the profits reaches 1 crore plus. So in this particular case, of course, the purchase consideration will be the same. So on the date of acquisition, of course, the purchase consideration is 225 lakhs, but after 1 year, the remeasurement will be done. So we can say after 1 year, when you do a remeasurement, so the contingent consideration was taken at 25 lakhs. Now the fair value of the contingent consideration is 40 lakhs. So after 1 year, you can say 15 lakhs will be debited to the profit and loss account. The increase in the fair value of the liability is going to be debited to the P&L and the financial liability will be credited. So the fair value changes gets incorporated. Trust me, if while doing this question, you could recall the concepts, then I think the concepts are going pretty well. So I think now we are completely done with the concept of 4 inputs to you. I've done DC. You should very be clear. Okay, the moment DC comes in the mind, your mind should immediately tell you, okay, DC means the present value, fair value, and it means post-business combination unwinding of discount. Then I say CCS, I need to consider a fair value and there will be a remeasurement depending it's a financial liability or equity instrument. CCE, no, it's not a part of PC. 102 would apply post-business combination. TC, not a part of the purchase consideration. Okay, so far so good. So 4 agendas done. Let me take you back now. So I'm coming back to the chain of thought which I gave you at the start, and let's discuss some more inputs related to the purchase consideration. So I started my journey, friends, on this area, and I gave you the list of the parameters. So we have covered the 4 parameters. Now we need to discuss the PHI, and we're going to discuss this in detail. So let's have a look at the concept of PHI. Now this is going to be slightly technical. I think since morning it's not been very technical indeed. I think the initial first class was slightly technical. The second also got a slightly technical. I think today it may not be very technical, but yes, now you're going to get a little flavor of the technicality because these 3 areas are slightly technical, and of course you can get independent questions on them. You can get a question on a step acquisition, a share-based payment, or a pre-existing relationship independently, maybe a part of the complete question, or maybe even just an independent question as well. So let's begin the journey. Let's now go on to the concept of PHI. Now watch me carefully. Now watch me carefully, friends, on the concept of a PHI. So let's take you to the concept of a previously held interest. Let me see in between if any questions coming to your mind so far. Okay, I guess the question is Namrata Koshki. So what is a transaction cost? Okay, as I said earlier, when I was giving the initial brief, the transaction cost would be something like, for example, you've incurred any amount of brokerage or commission. I think let's do one thing. Let's give you a practical illustration. I have put in a small practical illustration as well. Let's, I think, give you a small little practical question on the area. So it's there in the study material, and I put that in the assignment as well. So let me just take you to that. So let's have a very quick look on one question, which is on TC. So let's have a look on the question number 27, and that would give you the inputs. This is a question which is given in the study material as well. So let's have a look at this question. So that'll give you a flavor of what is the transaction cost as well. It says, should a stamp duty paid on acquisition of a land pursuant to a business combination be capitalized to the cost of the asset, or should be treated as an acquisition related cost and accordingly expensed off? Now, I would like to make it clear once again that when you acquire a single asset, be a tangible asset where Ind 16 would apply, or Ind 38 if it is an intangible asset, these acquisition related costs are capitalized. So let's make it very clear that if you're looking at Ind AS 16, or if you're looking at Ind AS 38, you can say the stamp duty which you pay on the land is something which is directly attributable. You buy a land and you pay a stamp duty, it's a part of the cost of the land. So if you apply Ind AS 16 or 38, this stamp duty, which is a transaction cost, acquisition related cost, is going to be capitalized. But the interesting part is that when you apply Ind AS 103, the same cost is being treated as revenue in nature. You got to take it to the profit and loss account. So this is called a transaction cost. So if there is any kind of cost, for example, in order to make a deal, you hired a middleman, you paid a brokerage and a commission to the middleman, then whatever transaction cost what you incurred is a period cost. Period cost in the sense that it's going to be treated as an expense in the period in which it is incurred. It cannot be taken as a part of the business combination deal. It is simply profit and loss debit, and the bank or the cash is given a credit. So this is the simple treatment of acquisition related cost, which I'm calling it as TC. So this is the example. So there is another example, a question which is given in this study material on intangible assets, but the concept is same. So any kind of transaction cost the company incurs during a business combination is revenue, but if it is incurred when you acquire a single asset on a standalone basis, is capitalized as a part of the cost of the asset. Right? I think that answers the query, I guess. Okay. Now let's take it further, friends. I am now going to take you to the concept of PHI. So this is interesting and slightly technical as well, but very interesting indeed. If you watch this carefully, you get the entire concept, of course. Let's now have a look on the concept of a PHI. So let's have a look at the concept of a PHI with you. The concept of PHI, that is previously held interest, also what we call is step acquisition. I'm going to give you a wonderful chart. But hear me carefully. The next 10 minutes is going to be a little crucial. And as we do the practical illustrations, you'll get the insight as well, but just watch this carefully. Well, first of all, what is coming to my mind is some permutation combinations. So I'm looking at, you can say, 2 permutation combinations. So we'll focus on the 2 permutation combinations and the treatment. Okay. So I'm looking at a column particulars, and I'm looking at the accounting treatment. Now, watch this carefully, friends. As I said, the next 10 minutes could be crucial. You will definitely understand if you hear and understand with open eyes and mind. I would say in a step acquisition, there are 2 permutation combinations. You were a passive investor earlier. The acquirer was a passive investor earlier, and now he obtains a control. So when I say previously held interest, it means you already had a stake in the company. And that stake could be a situation where you were a passive investor. Now, we need to first of all understand that when you were a passive investor, when the acquirer was a passive investor, this would generally be the case when you've got less than 20% stake in the company. When you've got less than 20% stake in the company, you're a passive investor, because at 20% or more, you get a significant influence. And since we are yet to do the standards on consolidations, let me first of all tell you, basically, I would say there are 2-3 kind of relationships which can happen. If you remember earlier also on day 1, I discussed that there could be a control when you get more than 50% voting power in a company. There could be a significant influence when you get 20% or more voting power in a company. There could be a joint control. Let's say if 2 people have got a 50-50 or 3 people have got 1/3 each. But if you're below 20% voting power, you are a passive investor. And what is important to understand is that if you are a passive investor, you would have been accounting under Ind AS 109. You would be accounting under Ind AS 109. So now you need to go back to Financial Instrument Standard and recall that when you had an investment in equity instruments, what was the accounting? And if you remember, in terms of Ind AS 109, the accounting was that you get a choice of either recording the investment at FPTPL or you get a choice of recording it at FPTOCI with a no recycling NR. So you would say, no, sir. It used to depend upon the fact whether it is held for trading or not. I think if the company had the intentions of going in for a step acquisition, I think it's pretty clear that equity investments was never held for trading. So the logical conclusion is that when you had less than 20% stake in the company, that investment was never held for trading. And if it was never held for trading, then in those particular cases, we can say it was never classified as held for trading and measured at FPTPL. So the company would have got an accounting policy choice of taking it at FPTPL or FPTOCI, which is always with a no recycling. Now, so which means that as a passive investor, you'll have to carefully evaluate the question that what was the accounting the company was doing previously. Was it accounting for the investment using FPTPL or was it accounting for the investment at FPTOCI? Accordingly, if it was accounting under FPTPL, what will I do on the date of acquisition? What will I do on the date of acquisition? I'll revalue the investment. I will revalue the investment on the date of acquisition, and any change in the fair value will be taken in the P&L. So on the date of acquisition, any change in fair value will be taken in the profit and loss account itself. So what I need to do in this particular case, if the investment is measured at FPTPL using Ind AS 109, this investment will be revalued. So you put the entry investment debit, P&L credit, or vice versa, as the case might be. So your focus is that before you look at the acquisition accounting entry, revalue this investment and the changes in the fair value are taken in the P&L. That's it. Next, I would say when you look at now the acquisition accounting entry, and you put the entry net assets debit and the PC is given a credit, you should include the previously held interest at a fair value. So we will include the PHI at a fair value as a part of the purchase consideration. So which means if you've got a previously held interest, it is definitely a part of the purchase consideration and it is taken at a fair value. So you need to do two things. You need to take it as a part of the purchase consideration, and at the same time, you need to revalue the investment, and any changes in the fair value is going to be taken in the P&L. Alternatively, if the investment is being measured at FPTOCI, I will again revalue the investment, but of course, the changes in the fair value, instead of being taken in the P&L, is going to be taken in the OCI. So as the methodology suggests, the measurement concept, that if it is FPTPL, the change in the fair value is taken in the P&L. And the change in terms of the fair value in the second case is taken in the OCI. And you should also remember that whatever is the accumulated balance, because when you take the investments at FPTOCI, the accumulated balance in OCI is taken in equity SOCI. So whatever is the change in the fair value each year, you keep accumulating that balance in your statement of changes in equity. So would you be able to transfer that accumulated balances in the P&L? Of course not. Now, since this is an investment which has got no recycling, you already have the knowledge from financial instruments that this accumulated balances will be transferred to retained earnings. You're going to simply transfer it to the retained earnings from the tab number 3 of the SOKI. It gets transferred to the tab number 2 of the SOKI. The tab number 3 of the SOKI is the OCI, and the tab number 2 is the reserve and surplus, which is the retained earnings. So whatever is the accumulated balances in SOKI, this is going to be transferred from the tab number 3 to the tab number 2 that is going to be transferred to the retained earnings. And of course, on the date of acquisition, the same thing will be done. On the date of acquisition, the same thing will be done. That means you are going to consider this amount that is as a part of the PC. So any previously held interest is going to be taken as a part of the consideration at a fair value. You need to do revaluations, and the revaluation changes will go to the P&L or OCI as the case may be, and the accumulated OCI needs to be transferred to the retained earnings. One. Second, the second permutation combination which arises is that, let's say you already had a significant influence and you are now converting to the concept of control. Now, this is a crucial case. That means you as an acquirer had a significant influence over the acquiring company, and with a further percentage, you've achieved a control. So a significant influence means you had a 20% or more stake in the company. So you had a significant influence, and as a significant influence, you would have applied Ind AS 28. Though we yet to study that, because we yet to study the concept of Ind AS 28. But I think with your intermediate knowledge, or maybe a little knowledge, you would know that Ind AS 28 discusses what we call an equity method of accounting. It considers what we call an equity method of accounting. So as per Ind AS 28, the company would have applied, as per Ind AS 28, the investor would have applied what is called an equity method of accounting. I'll not get into the equity method of accounting at this stage. I'll not get into the equity method of accounting, but I think you got a little flavor of that even in terms of Ind AS 12. If the need be, we'll just make a quick inputs to you as I do a practical illustration. But in Ind AS 28, you would have applied an equity method of accounting. So what do we do now at this particular stage? So on the date of acquisition, you need to again consider and revalue the investment. So whether it's a passive investment or whether it's a case of significant influence, you need to revalue the investments at this date. So on the date of acquisition, we will take the revaluation, and the change in fair value is going to be taken in the profit and loss account. The changes in the fair value increase or decrease will be taken in the fair value. And trust me, the same thing will be done here itself. So in my acquisition accounting entry, the purchase consideration will include the PHI at a fair value. So you need to include the PC, the PHI in the PC at a fair value, and the revaluation will be done. But there is something more to be done. There is something more which needs to be done as well, which is very interesting indeed. And this is where you can get a question. So I think, let me consolidate the picture before we take it further, because I need to basically now elaborate to you what is that something more. What is that extra thing which you need to do in this particular case? So let me consolidate the picture. Let me see if any questions coming in between so far. Okay. Okay, Namrata, you tell me, so not able to understand the FPD OCI. And you said, what is the difference between a transaction cost and a transportation cost? Well, a transportation cost is something which you might have heard in terms of Ind AS 113, when you're looking at the calculation of the fair value. But in terms of business combination, we are not looking at the transportation cost. Transportation cost is like, bringing the goods, at the principal market or the most advantageous market. So that is not a term which is going to bother in terms of 103. So when I'm looking at transaction cost, I'm looking at brokerage. I'm looking at the commission. So I'm looking at like the stamp duty paid on the registration of the land, etc. the legal fees which might be paid, etc. So we are saying that, things which might be incurred in order to get the deal done. So you hire a middleman, you pay a commission and brokerage. So that is a transaction cost for the purpose of Ind AS 103. Transportation cost is something which is going to bother when you calculate a fair value under Ind AS 113, nothing to do in terms of this standard, right? Okay, now as far as FPT OCI is concerned, I guess, friends, you have done financial instruments already, so I can't get into the details of, what is an FPT OCI, etc. But I guess I'll just give you a fair idea of what exactly is done. Okay, so I believe, you've all done financial instruments, so we can't get into the detailed discussions of that. For that, you can refer the financial instruments lectures. I'll just now quickly give you first a consolidation of this aspect. Now, hear me very carefully. As I said, the 10 minutes are done. Now, the next 5 minutes is going to be even more crucial because I'm consolidating the learnings. Now, you need to keep one thing in mind, that what we're looking at is a company acquirer already had a stake in the acquiring company. He already had a stake before he got a control. So there are only two permutation combinations which can arise in a step acquisition. So since you already had a stake, you were a passive investor. Now you need to remember that when you were a passive investor, which means what? That you had less than 20% stake in a company. Now, you need to immediately recall that if you are a passive investor, then you would be accounting for that investment under Ind AS 109. Because when you look at a investment in equity instruments, related party investments are not covered under 109. You must be already aware that as far as investment in equity instruments of related party are concerned, it is accounted under Ind AS 27 and not under Ind AS 109. So it is only investments in equity instruments in unrelated party where you are a passive investor is accounted under 109. So when you read a question that what was the previously held interest, you should immediately recall that, okay, if you were a passive investor, you are following Ind AS 109. So you need to understand that what was the accounting treatment done under Ind AS 109. Ind AS 109 tells you that you need to conduct a held for trading test. If an equity investment is held for trading, then you can measure it only at FPTPL. But if it is not held for trading, then Ind AS 109 gives you a choice of accounting that it says you can either consider FPTPL or you can consider FPT-OCI. The difference between the two is that if it is FPTPL, the change in the fair value enters the P&L. And if it is FPT-OCI, the change in the fair value enters the other comprehensive income section of the income statement. Now, considering that the company had intentions to acquire a control, I guess it's a logical presumption that investment was never held for trading. When the company would have, is it held for trading? I think the answer should be no, because if the company intends to acquire a control over that company at a later date, it was surely not held for trading. That means the company might have chosen either this route or this route. That instructions would be given in the question, that whether the company under previously held interest was accounted under which method. So you need to do two things. One is a very simple thing, that you need to consider the fair value of the previously held investment as a part of the PFC. So what I'll do, I will take the PHI at a fair value and take it as a part of the purchase consideration, simple and straight. The second thing which you need to do is you need to make a revaluation of the investment on the date of acquisition. So before the acquisition accounting, before you do the acquisition accounting entry, just put a simple entry, investment debit, P&L or OCI credit, or the reverse entry as the case may be. If the fair value has gone up, the entry is investment debit and you give a credit to the P&L, sorry, or the OCI as the case might be. So the fair value changes in the investment needs to be recorded and taken in the P&L or OCI. That's it. So the focus point is revalue the investment, get the fair value changes, put it in the P&L or OCI as the case may be. And number two, take it as a part of the PFC. I hope that part is clear. The second situation which could arise in terms of PHI is that you were already having a significant influence over the company. Now, the moment you say that you had a significant influence, as I said, it becomes a related party transaction. Then this investment was never accounted under 109, because I made it very clear that equity investments in unrelated party, a passive investment, is covered under 109. So when we were having a significant influence, we would have accounted the investment, you can say, as per Ind AS 28. Now, separate financial statements, you would have applied the Ind AS 27, but you would be consolidating and you would be applying Ind AS 28, which is technically called an equity method. Let's not get into what is equity method at the moment, but you would have applied an equity method, and trust me, you need to do two things again. So what do you need to do? You need to take the fair value of the PHI as a part of the purchase consideration. Same thing. The PHI will be taken at a fair value as a part of the purchase consideration, one. And second, you need to make a revaluation of this investment, and any changes in the fair value is going to be taken in the P&L, simply. But there is something more which will be required to be done. Because if your previously held investment was a case of an equity method, there is something more which needs to be done, which I'm going to elaborate now, because for that we need to get a little understanding on the equity method, which I'll explain with a practical illustration itself. Okay, I guess so far so good. I think, Namrata, you would have got your answers, I guess. Are you being able to catch the points? The main highlighted points that you need to consider: the PHI at a fair value as a part of the PC, one, and you need to consider the investment, the main focus, the fair value changes, P&L, OCI, as the case might be. In this case, it goes simply to the P&L, right? So far, so good, I guess. Great. That's wonderful indeed. Let's now take it a little further. I'm now going to take you to a small little question, which we're going to solve, not fully solve right now. I'll just discuss a bit, then I'll give you a break in a few minutes' time so your mind gets relaxed. But let's, I think, take this further. I am now going to take you to a very interesting question, which is in the study material as well, and it's given in the education material as well. And I think it's come in a couple of the RTPs, and it's come in the past examination question as well. So let me, I think, first of all, take you to a small little question on this area. It's a very interesting question indeed. Let's have a look at the question with you. Okay, so I am taking you to this particular question. This is on a PHI. First, we'll go to a very simple question, friends, with you. So this is on the previously held interest. I think let's pick a small question to begin with. I need to clear this out. So let me first take a very simple question based on a passive investment. Then I think we can take a break after that, and then we can talk of the significant influence part, which is a little tricky part indeed. Okay, let's have a look first of all on a question with you. And this is question number 19 on a PHI. It says on 1st April, a company A acquired a 5% of the equity share capital. It's very clearly given that it is supposed to be 5% of the equity. 5% means that we were a passive investor. And since we were a passive investor, this means we would have applied Ind AS 109. Now it's got to be seen whether this investment was accounted under FPTPL or FPT OCI. That instructions will be given in the question. So it says on 1st April, the company acquired 5% share capital that was for 1 lakh rupee. Then he says A accounts for the investment at a fair value through OCI, FPT OCI under Ind AS 109 financial instruments. Then he says on 31st March X2, that is after 1 year, A carried the investment at B at a fair value and reported an unrealized gain of 5,000 in the OCI, which is presented as a separate component of equity. That is, he's talking of SOKI. So we know that since the investment was measured at FPD OCI, the company would have taken the fair value changes at the end of the first year in the other comprehensive income. So 5,000, which is a fair value change, it's an unrealized gain, was taken in OCI, and then it was taken in the statement of changes in equity. And then it says on 1st April 2000 X2, A obtains a control by acquiring the remaining 95%. Comment on the treatment to be done given the facts in the question. So there are two focus points. We are converting from a passive investment into a case of control. So what do I need to do? Number one, we are going to take the PHI as a part of the purchase consideration. So we will take the previously held interest added to the PC. Because there is a consideration which you're paying for 95% today, and you're going to add the consideration which you already paid for 5%, but at a fair value. So what is the fair value today? We know the fair value is supposed to be 1,05,000. 1 lakh was paid on 1st April X1, 5,000 was a change on March X2, as good as April X2. So you're going to take this as a part of the PC at 1,05,000. So since the amount is already standing at a fair value in the books of accounts, there is no need to revalue the investment. It is already standing in the books of accounts at a fair value, because incidentally, the date of acquisition is 1st April, which is as good as 31st March. So we're going to take it as a part of the PC. That's one. And in this case, revaluation is not required, because the investment is already at a fair value in the books of accounts. So what do you need to do? You just need to consider that the accumulated balance in OCI, which is to the extent of 5,000, which is in the statement of changes in equity, you just need to transfer it to retained earnings. It's going to be transferred to the retained earnings. That's it. The company is going to simply take that 5,000, which is the accumulated balances in the other comprehensive, in the equity statement, tab 3. You're just going to transfer that money in retained earnings. Since it's no recycling, it cannot be rooted in the income statement. That's it. So this was one example where you're converting from a passive investment into a case of, you can say, control. I hope, friends, that illustration is pretty much clear, I guess. Okay, I think now it's time to give you a little break as well. I'm sure you'll need one. So I think before we take to the second case, a significant influence converting into control, let's give you a break. So we'll take a 10-12 minutes break so that you can relax your mind, because I need to give you that something else which is to be done in terms of Ind AS 28. Right, friends. So I think it's almost around 8:46 or something. So we'll just take a 10-12 minutes break, 8:47 to be precise. It's clear, wonderful indeed. And we'll just join you into 10 to 12 minutes time frames. Let's take a break. Welcome back, friends. So I guess you had a relaxed mind. So now let's take it further. I have already discussed with you the nitty-gritties in terms of a PHI. That is, if you've got a previously held interest as a passive investor, and we did a small little question with you on that area. Now I'm going to take you further in terms of the second aspect through a practical illustration that if you were already having a significant influence over the company and it gets converted to the concept of control, then what do you do? So I think let's have a look at that something else, for which I'll have to give you a little inputs in terms of the equity method. I know we yet to cover the equity method under Ind AS 28, but to the extent we require this for the purpose of this standard, I will give you the inputs. So let's, I think, read a question with you. So I'm going to go to the question number 20th. It's a question in the study material as well. It's come in the exams as well, a similar kind of question. So very interesting and a good question. It says in question number 20th, on 1st April X1, PQR acquired a 30% voting power. So 30% voting power would mean that the company got a significant influence and we started applying Ind AS 28 for consolidation perspective. Then it says we got a 30% voting shares in XYZ for a total of 8,000 crore. He very clearly makes a mention that PQR accounts for the investment using the equity method as prescribed under Ind AS 28. Then he says on 31st March X2, which is the end of the year, PQR recognized each share of the net asset changes in XYZ using equity accounting as follows. Now, I think at this stage, let me first elaborate the basic essence in terms of equity method of accounting. Though if you recall, even in terms of Ind AS 12, we had a bit discussion as far as the equity method of accounting is concerned. But let's get this again very clear. Just imagine that this is the investment. This is the investment, that is 8,000 crores at which you acquired the investment. And correspondingly, this is the net assets of the investee. Now, the essence of the equity method of accounting is that your investment should always appear at the share in the net assets of the investee. I repeat it. So the essence in terms of Ind AS 28 is that the investment should always appear at the share in the net assets of the investee. So let's say this is the investment and let's say this is the net assets of the investee. So what you need to do in terms of equity accounting is that if the net assets of the investee company moves up, I am supposed to account for the share in the increase in the net assets. I will not consider the entire share. I will only consider whatever is the increase in the share in the net assets, which means that in this particular case, if the net assets of the equity, the net assets of the investee increases, let's say by 200 crores, and I've got a, let's say 25% or let's say 30% stake in the company, you got to increase the investment by, you can say 30% of 200 crores. So every time the net assets of the investee company goes up, you need to pass an entry investment account debit to the extent of share in the net assets. But the question arises, what is the amount, where are you going to give a corresponding credit? So let me do one thing. Let me just take a very basic example so that you get started on this area. So let me just, I think, add on something further. Now, let's take a very basic example to see the movement of equity, because for that purpose, we need that clarity. So let's consider there is a company A Limited, and let's say it acquired in terms of B Limited, let's say a 30% stake. Let's say the net assets of B Limited on the date of acquisition at a fair value, let's keep it as, or let's take 25% to make it calculations more eased. Let's say this is 25%. Okay, let's say the net assets at a fair value is to the extent of 100 crores. So let's say the net assets of B Limited, when A acquired a 25% significant influence over B, let's say the net assets at that time was to the extent of 100 crores. Now, let's say he acquired this investment at a cost of 25 crores. I don't want to bring goodwill into account, so I'm keeping it safe that let's say he acquired the things at 25 crores. So keeping it simple. So see, what is the net assets of the investee company? It's 100 crores. And what is the cost of the investment? It is supposed to be 25 crores, standing exactly equal to the share in the net assets of the investee. Now, what happens subsequently? Let's say in a post-acquisition period. Now, let's say in the post-acquisition, the company B Limited earned a profit, let's say to the extent of 20 crores. Let's say they earned a profit to the extent of 20 crores. Now, what happens? When the investee company earns the profit of 20 crores, the equity or the net assets increases by 20 crores. But what am I supposed to do? I will take a share in the 20 crores, that is 25%, and I will put the entry investment debit 5 crores. So what he would do, he would incorporate this increase, that is 25% of 20 crores, and he will increase the investment by 5 crores. But the question arises, where is going to be the corresponding credit? We'll see those details when we come to Ind AS 28, but where are we going to take this increase? Now let's watch this carefully. This profit of 20 crores is comprising of a profit in the profit and loss section and a profit in the OCI section, because your income statement is comprising of, you can say, the P&L and the other comprehensive income section. So let's say the breakup of this 20 crores is that 12 crores is in the P&L section and 8 crores is supposed to be in the OCI section. Now, watch this carefully. So as I said, that if the company, the investee company, earned a profit of 20 crores, then I need to increase the investment by 25%, that is 5 crores. But where will the corresponding credit go? I will take 25% of 12 crores as a credit to the P&L. I will take a 25% of 8 crores as a credit to OCI. So the corresponding credit will be taken to the P&L and to the OCI, because the profits are split in terms of the P&L and the OCI section. So you take 25% of 12 crores, that is 3 crores. You take 25% of 8 crores, and that is 2 crores. This is how the equity method of accounting would be done. So you need to be a bit clear on the accounting if I need to account for the step acquisition. So the moral of the story is very simple. That when a company had a significant influence and then it acquired a control, so when it had a significant influence, it was accounting using, we can say, equity method of accounting. So if they were applying the concept of equity method of accounting, then in this particular case, we can say the moment the equity or the net assets of the investee, which is the associate company, moves up or down, it moves up or down, you need to make a reflection of that in the investment account. The equity or the net assets moves up, the investment value moves up to the extent of share in the increase. The equity or the net assets moves down, you need to decrease the investment to the extent of share in the decrease. But when you increase or decrease the investment, there will be a double entry bookkeeping as well. So in this particular case, as we said, if there is a profits, you need to watch out that this profit is comprising of what component in the P&L and what component in the OCI. So accordingly, the credit in the books of the investor would have taken place in the P&L and the OCI, which means as a part of the equity method, he would have taken some credits to the P&L and he would have taken some credits to the OCI. And I think I don't need to remind you, you know this very well, that this OCI comprises of the no recycling and the recycling component. The other comprehensive income is comprising of the recycling and no recycling. So you mean to say that when you're going to give a credit in the OCI in the books of investor, you would also make a split that out of the 2 crores, what relates to no recycling and what relates to the recycling component? Exactly, yes. So you can say as a part of the equity accounting, the investor would have taken a credit to the P&L, or he would have taken a credit to the OCI, that is NR, no recycling, or he would have taken a credit to the OCI, which is with a recycling. So, but why are you looking at those details? That as an investor, when you took a corresponding credit in the books of accounts, and that is in the P&L or OCI R or NR, how does that make a difference? I'll explain that. Back to the question. Let's take it further. Let's read it further. So we were reading this part of the question. Let me just take it back. So I'll just take you back further and let's read it further. Okay, so in this particular part, as I gave you, we read just in this particular part, we just read it, that on 1st April, you acquired a 30% stake at 8,000 crores. The investment is accounted under equity method Ind AS 28. And then it says PQR recognized the changes in the net asset using equity accounting as under. Now see what they have done. Let me just take it back. Now see what they've done in this equity method of accounting. So this is interesting to watch. Oh, where did my question go? I think it's got slightly mixed up. Just a second. That's question number 20. Then I think something got messed up. I think just give me a second. Let me just load the slide once again. I think the question got mixed up. It got deleted by default. Just give me a second. I'll just add the questions once again to you. So let me just take you back to the detail further. Yes, so let's read it further. Now see, watch this carefully. This is a similar question which came in the exams in June 19, 8 marks as well. What I'm doing right now is a question from the education material, a similar question you could practice and see in terms of the June 19 exam. Now, further what it says, how the accounting was done. The company, as a part of the equity accounting, took the share in profit or loss, that is 700 crores. So what the company must have done, the associate net assets went up, and I did the entry as an investor, investment account debit to P&L, 700. Then it says there is a share of exchange difference in OCI, and there is a share of revaluation reserve of PPE in OCI. So here again, the amount of equity must have increased for the investee, and I must have done the entry investment account debit to OCI, that is to the extent of 150 crores. So they took a credit to the profit and loss account, and they took a credit in the other comprehensive income as a part of the equity accounting. Mind it carefully. So they have done the entry investment debit P&L credit, investment debit OCI credit. Now, watch this carefully. Can I say as a part of the equity accounting, when they took the exchange difference in OCI, this exchange difference arises due to Ind AS 21. This exchange difference arises due to Ind AS 21. So now you need to apply your mind using your knowledge on Ind AS 21, that was this amount relating to recycling or no recycling. This amount, which is called an FCTR, that is foreign currency translation reserve, relates to something which will be recycled back to the P&L once the disposal of this associate takes place. Secondly, if you look at the revaluation reserve of PPE, you need to go back and apply the concepts in terms of Ind AS 16 and recall that when a revaluation gain used to arise, then that amount used to be taken in OCI, and that was with a no recycling. Which means, as a part of the equity method of accounting, you need to be very careful that when you took an amount in the OCI, was it an amount taken in OCI R, or was it an amount taken in OCI NR? And accordingly, now we need to move further. It says the carrying amount of the investment in the associate on the balance sheet date is therefore 8850. The investment was acquired at 8,000 crores, and then you added these three components, putting the entry investment debit to P&L, investment debit to OCI, as the case might be. So we have basically enhanced the investment based on the net assets of the associate company. On 1st April X2, PQR acquired the remaining 70% for a cash consideration that is 25,000 crores. And the following information is given. The fair value of the PHI, that is 30%, is already given. And we are also given the fair value of the net assets as well. How should a business combination be accounted for? Now, let's have a look at how the accounting in this particular case is going to take place. Watch me very carefully, friends, out here. So just to get the facts very clear, so what we are given in this particular case is that, first of all, using the equity method of accounting. First of all, using the equity method of accounting, what the company did, it did the entry investment account debit. It gave a credit to the P&L. It gave a credit to the other comprehensive income. So this is the entry which is done using Ind AS 28. So this is the entry they've done already for the previously held interest in terms of Ind AS 28. So I think if you just pick up the figures, then what is the amount of credit they have given in the books of accounts? Let me just pick up the figures. So they would have taken a total of 700 crores in the P&L, and they would have taken 150 crores in terms of OCI. So the total debit of the investment is 850. Therefore, it says that the investment in the books of accounts is standing at 8,000 crores, initial cost, plus another 850 crores, makes it a total of 8850 crore. This is the application of the equity method. Now let's come to Ind AS 103. Now, in terms of Ind AS 103, what I need to do? In terms of Ind AS 103, what I need to do? Watch this carefully. Before you pass the acquisition accounting entry, you are going to pass two entries. Get this very clear. This is an entry which you need to pass before the acquisition entry. The acquisition entry, I'm going to do two things. Number one, revalue the investment. I'm going to revalue the investment. So we are given the fair value of the previously held interest is 9,000 crores. I am given that if you look at the fair value of this investment today, on the date of acquisition, it is 9,000 crores. So I said, you need to go in for a revaluation of this investment. So an increase in the investment was going to be given a credit to the profit and loss account. Whatever is the revaluation gain, increase or decrease in the fair value, that's going to be taken in the P&L in this case. So 150 crores is the gain which is arising on account of fair value change. One. Second very important thing. Since the relationship from a significant influence has changed to a control, what do you need to do? There is now a derecognition of the PHI. The previously held investment accounted under equity method is derecognized and a new investment comes into place. So now it's time that the amount which you took in the other comprehensive income, which is accumulated in SOKI, is now to be transferred to the P&L or the retained earnings, depending there is a recycling or not. Like, for example, this 100, which is supposed to be accumulated in the OCI, is going to be transferred to the profit and loss account because it is a case of recycling. I mind it again. This 100, which arose on account of Ind AS 21, is supposed to be an amount which needs to be reclassified, recycled to the profit and loss account. So you need to put this amount to the P&L because the investment is getting derecognized. And this amount of 50, which is also in the OCI, but it is something which cannot be recycled to the P&L. So this is going to be directly transferred to the retained earnings at this stage. Let's get this position once again very clear. So you need to be watchful on the fact that when a equity method, that means a significant influence changes to a control situation, you need to put 2 entries before the acquisition date. At the first instance, you need to make a revaluation of the investment, and any profit or loss arising on a revaluation is going to be taken in the profit and loss account. Simple. Second, you need to see that whatever was accounted under equity method and was taken in the OCI, you need to see that amount and scrutinize it. That the amount which was taken in the OCI earlier due to the equity method of accounting, that amount is to be scrutinize. Is it amount relating to recycling, or is it an amount relating to no recycling? The amount which relates to recycling has to be transferred, you can say, in terms of the P&L, and the amount which relates to no recycling has to be transferred to the retained earnings. So the question is going to give you a status that as a part of the equity accounting, what was the amount which was taken in the OCI during the equity method accounting? Scrutinize that accumulated amount in OCI, identify how much of that relates to recycling that needs to be transferred to the P&L today, and how much amount is relating to no recycling, and that is to be pushed to the retained earning. After this, then you are comfortably going to pass on the date of acquisition, the acquisition entry. So when you put this entry, I am given a data in the question. If I want to pass the acquisition entry, we are given the fair value of the net assets is 30,000. And if I take the purchase consideration which I'm going to consider is now going to be including the PHI at a fair value. The company acquired a 70% stake at 25,000 crores. You've acquired the remaining 75% shares, 70% shares at 25,000 crores, and the PHI has got a fair value to the extent of 9,000 crores. So we've taken care of the second impact as well. We've taken the PHI as a part of the fair value accounting. So in this particular case now, you would get a balancing figure. In this entry, this is 34 versus 30. So you get a balancing figure, goodwill, which is 4,000 in this entry. I know it's really complicated indeed. Don't worry, I'll just consolidate the picture once again. I'm sure there might be a few questions definitely coming to your mind as well. So let me, take those questions further first of all with you. Okay, I think Rahul, you said, so please throw some light on no recycling versus recycling. What is the reclassification and what is not a reclassification? I guess, friends, you might have covered all this bit in terms of financial instruments. I'll give you a very quick brief on it, but I guess if I start getting into that part, it can be complicated affair. But I think let me ask, how many of you have the clarity in terms of, what is reclassifying and no reclassifying? Otherwise, I'll take 5 minutes and give you a quick brief on things, because you've covered that in Ind AS 1, you've covered that in detail in financial instruments. So I don't want to get into a detail mode on that. But how many of you want me to give you a quick brief or 5 minutes on that area so that we get a little more clarity and we can connect better to the PHI? So give me your inputs on that, friends. Then I'll do my discussions further. Koshki says, yes, we have covered that OCI part as well. Okay, so how many of you would want me to give you a quick review? If you could just send me a message, then I think I'll just give you maybe a 5 minutes quick review on things. Yes, a quick review. Okay, so we'll give you a quick brief on that, not an issue. So let's take the journey forward. Let me just give you a quick brief. Then I'll consolidate this picture as well. So I think I'm going out of the standard at the moment and going to give you something. Okay, so hear me very carefully, friends, on what we're discussing, and just have a quick look at this. My focus right now is the income statement. You've got a profit and loss. You've got an other comprehensive income. And as you know that OCI has got a section which is no recycling, and there is a section which is called recycling. Now, hear this very carefully. The 5 minutes very crucial because it'll give you a good thought and consolidate what you've already learned. Let's take some arbitrary figures. Let's say in the profit and loss, the profit is 20 lakhs. Let's say in the recycling, no recycling, the profit is, let's say 8 lakh. And let's say in the recycling, the profit is 2 lakh. So we get a total comprehensive income. And the total comprehensive income works out at 30 lakhs. So I've just taken some arbitrary figures that you've got a profit in the P&L section, then there is OCI, no recycling and recycling, and that's how you get your total comprehensive income. Now, you need to first of all understand and appreciate the concept of OCI with the help of, let's say, I am given the number of equity shares. The number of equity shares, let's say, is to the extent of 5 lakhs. I need to calculate, let's say, my basic earning per share. Now, you might be already knowing that when you calculate a basic earning per share, the basic earning per share will consider only 20 lakhs to calculate EPS. What goes in the OCI section is not taken in the EPS calculation. So OCI basically parks in things which do not affect the earning per share of the company. So in this particular case, the EPS is going to be 20 divided by 5, that is 4. It's not 30 by 5, mind you, because many people, conceptually go wrong and they take the EPS as 30 by 5. It's going to be 20 by 5. So OCI section doesn't enter the EPS calculation. That is focus 1. So you need to keep this very clear. It does not affect the EPS. So it definitely affects the profits of the company. What goes in the OCI is a part of the profits, but it doesn't affect the earning per share of the company. Now, what do you do when you prepare a SOKI? What do you do when you prepare a SOKI? A SOKI is basically, you can say, got 3 tabs. If you look at SOKI, it is basically got 3 tabs. That's what we do in a practical life situation. If you see financial statements in a practical life, you'll see that the SOKI is, technically divided into 3 tabs. The tab number 1 is where you take the equity component. The tab number 1 is where you take the equity component of compound financial instruments, which arises on account of Ind AS 32. So when you apply the concept of Ind AS 32, in those particular cases, the equity component of compound financial instruments is supposed to be taken as a part of the tab number 1. The tab number 2 is basically the reserve and surplus. And one of the major elements in terms of tab 2 is supposed to be retained earnings. So when you consider the tab 2, you've got reserve and surplus, and one of the major components is in terms of what we call the tab 2. And in terms of tab 3, whatever is taken in the OCI section, whether it is no recycling or it is recycling, that enters the tab 3. So technically, when you start posting a profits of the current year, when you start posting the profits of the current year, how do you post an income statement to a SOKI? So we will consider, let's say this is the total comprehensive income with the same example. You got a total comprehensive income of 30 lakhs comprising of 20 lakhs in the P&L. So 20 lakh enters in the retained earnings column. 20 lakhs is put in the retained earnings column in the tab number 2, which is the retained earnings. And then this 8 and 2 lakhs is entered in the tab number 3 under respective columns. It is taken under respective columns, whether 8 lakh, let's say, is relating to a debt instruments measured at FPT OCI. And let's say 2 lakh relates to an equity instruments measured at FPT OCI. So you put them under respective columns. So that is how the posting of that 30 lakhs is done. This is something which you learned in terms of Ind AS 1, how the posting of a total profits is done in terms of SOKI. So when a company earns a profit in the P&L section, it enters, you can say, the tab number 2. What is taken in the OCI section is entered in the tab number 3. So this enters the tab 2 and all this enters the tab 3. This is the basic principle which you need to keep in mind. Now, ultimately, what happens to the amount which is taken in the OCI? So my focus now is that when you've taken the amount in terms of the OCI, in this particular case, what happens in this particular case? What happens to the amount which is ultimately taken in the tab number 3, which is in the OCI? In this particular case, when you put the amount in the OCI, ultimately what will happen, now watch this carefully, ultimately what will happen in this case? This amount ultimately is going to get transferred in the retained earnings. This amount is ultimately going to be transferred in the retained earning. The parking of the amount in the tab number 3, which is the OCI, is a temporary parking. So ultimately, this amount is one day going to come to the retained earnings, but it may move directly, indirectly. This movement could be, either direct, or the movement could be something which is indirect in nature. Now, let me explain what is this direct and indirect movement. When the amount is a case where there is no recycling, when you put an amount in the no recycling component, then the amount which is taken in the no recycling component is taken directly to retained earnings. The amount which relates to no recycling is taken directly to retained earnings. So this amount will be taken and subtracted from the tab 3 and added to the tab 2 when the amount gets realized. Because basically, you can say that the amount in the OCI is an unrealized gain or an unrealized loss. So the moment the amount gets realized in nature, the investment is being sold, for example, or the associate is being disposed of, the subsidiary is being disposed of, the amount of unrealized gain or loss technically gets converted into a realized gain or loss. So the amount which is in the no recycling component is going to be simply subtracted from tab 3 and added to the tab 2. This is called a direct transfer. This is, you can say, no recycling, no reclassification actually. Okay, now coming to the indirect part. The amount which is taken in the recycling part is again taken to tab 3, but it's not going to be subtracted from tab 3 and taken to tab 2 directly. In the year when the sale of investment took place, whatever is the accumulated amount in tab 3 will be taken to the profit and loss section in a future year. So whatever is the accumulated amount which is there in tab 3 is going to be taken in the P&L account of a future year. And when it enters the P&L account, automatically it enters in the retained earnings in the future year. So the indirect transfer takes place for the recycling amount. So let's get this very clear, that when a company makes an income statement, your mind should be very clear that the amount in the profit and loss section is something which enters in the tab number 2, retained earnings. The amount which is taken in the OCI with the recycling or no recycling is taken to the tab number 3. But tab number 3 is a temporary parking place. The amounts which are taken in the tab 3 one day when the gain is or the loss is realized, it will be shifted in tab number 2. You're going to move the amount from tab 3 to the tab 2. That movement could be something which is routed through the P&L, or the movement could be something which is directly moved. When an amount is relating to no recycling, it is a direct movement. It's not rooted in the P&L. So once the amount gets realized, you just need to reduce the amount from this column and add it to the retained earnings, like a revaluation surplus. When the PPE is being sold, you are going to reduce the amount of revaluation surplus from tab 3 and just simply add it to the retained earnings, because when it is a part of the tab 3, it's not available for dividend distributions. And the moment it enters the tab number 2, the amount becomes available for dividend distributions at that stage. So that is no recycling, that you reduce from tab 3, add it to tab 2. So that direct transfer is called a no recycling. But then the amounts which are taken in tab 3, which is reclassifying, recycling, this is an amount which will get reduced from tab 3, but you're not going to subtract and just add it here. This amount will be transferred in the P&L in a future year. It's going to be transferred in the P&L in the future year, and through that P&L, it will enter the retained earnings indirectly. So this is like a temporary parking space. If you move it without routing, no recycling. If you move it after routing, it is called reclassifying. And if you look at the tab number 3 of SOCI, you'll see various elements in tab 3 related to Ind AS 21, related to Ind AS 16 and 38, revaluation surplus, and a lot of components relating to Ind AS 109. Debt instruments through OCI, equity instruments through OCI, and the concept of the cash flow hedge reserve which is there. So this is the basic overview in terms of things, right? I hope that answers your question. I hope everybody gets the inputs on that. Okay, completely clear now. You most welcome, dear. That's great. Okay, I guess everybody got the inputs on that. Now let's take it further, friends. Coming back. So I'm now coming back to the agenda, and I'm coming back to the answer which I did in this case. Let me now consolidate the step acquisition. When you convert from, you can say, a significant influence to a control. So just keep that question in mind and let's have a look at this. I'm just going to give you a full consolidation in this particular case. So let's have a look, friends, on this. The focus number one is you need to be a little clear on the equity method of accounting. Now, under the equity method of accounting, the accounting is fairly simple, though we'll see that when we come to Ind AS 28, but I've just given you a very basic idea, which is also a good idea as well. Now, you need to consider that this is investment of the investor, and this is the net assets of the investee. So we're looking at the investment on one hand and the net assets or the equity of the investee. The rule is principle, basically very simple. If the net assets or equity moves up, you need to also increase the investment value. If the net assets move down, you need to bring down the investment value every time to the extent of share. Every time to the extent of the share. So if the net assets moves up by X amount, you need to take 25% of X. If it moves down by Y amount, you need to take 25% of Y. So if the investment is to be increased, investment debit. It is to be decreased, investment credit. And correspondingly, where do you take the credits in this case? So for this, we were given that an associate company, let's say, earned a profit. So they must have taken some profits in the P&L section. They would have taken some profits in the OCI section. So in this case, when I do the investment accounting, I would have taken the share in the profits in the P&L credit. I would have taken the share in the OCI section in the OCI credit. So as an investor, I would have taken a credit in the P&L. I would have taken a credit in the OCI for the share in the movement of the profits. So as an investor, I would have accumulated something in the P&L. I would have accumulated something in the OCI. So when you convert from a significant influence to a situation of control, what you need to see is you need to make a scrutiny of the OCI. I'm not concerned with what was taken to the P&L. I'm not concerned with that 700 which was taken in the P&L. My concern is only the amount which was taken in OCI, that is in tab number 3. So what do you need to do? Since the investment is changed from a significant influence to control, that means it would be considered as a derecognition of the investment. And when the investment will be derecognized, what do you need to do? You need to scrutinize the amount in the OCI. And you need to see that, okay, is this amount relating to R, recycling, or is it relating to NR, there is no recycling? We know now the knowledge that if it relates to recycling, then in this particular case, it is got to be transferred to the P&L, rooted in the P&L, so that it enters the tab 2 RE. And if it is no recycling, it is going to be simply taken a direct transfer in the retained earning column. So the accumulated balance in the OCI will be scrutinized for the amount which is recycling taken to the P&L. And the amount which is relating to no recycling is taken in the retained earning. This is an extra exercise to be done when you convert from an equity method of accounting into a controlled situation. I hope I'm pretty clear now. So you do 2 entries, revalue the previously held investment at a fair value. So the fair value changes are taken in the P&L simply. And then the accumulated OCI is scrutinized, taken in P&L or RE, and then you can pass an acquisition accounting entry. Right, so this is on the PHI. I hope, friends, everybody is now fully clear with the inputs we have discussed so far. Okay, Namrata, it's interesting. Koshki, super clear. That's wonderful indeed. Great. Okay, so now let's take it further. So just a quick summary of the PHI to you. Just a quick summary in terms of PHI. We've done the questions also with you, but just to consolidate the picture. So we've done DC, we've done CCS, we've done CCE, we've done TC, and we've done PHI. Then comes the concept in terms of share-based payments and pre-existing relationship. Okay, but before that, let's take a quick review. So let's, I think, first of all, take a quick review of the concept of PHI, just a quick mind map. So we can say that there are going to be two situations. So just a quick mind map on things before we go to the share-based payments, just a quick mind map on this. And I would request friends, as I said earlier, please keep making a cumulative revision. I know the standard is pretty complicated. And that's the reason it comes in the exam for almost like 16 or maybe 20 marks, 15 to 20 marks, anything. And it could be shorter as well. But it's a very important, I think one of the good questions which came this time in the exam was also pretty good, quite similar to what was there in the study material as well. But you know, a quick revision, a consolidated revision will give you a very good hold. Because I think since there are too many issues, it's all about remembering, what is to be done at the right time. If you recall things, it's easy. Okay, now in terms of PHI, there will be two cases. You convert from a passive investor to control, or you convert from a significant influence to a control. So you watch out in the question, what is the situation? Is it a case of a passive investment to control or a significant influence to control? Immediately, your mind should start giving answers. Okay, passive investor means you were accounting under Ind AS 109, which means you were accounting under FPTPL or you were accounting under FPT-OCI, and it's always no recycling for equity investments. Equity investments are never taken at R. Equity investments as per financial instrument standard is always a case of no recycling. So what I need to do, number one, when I take the PC, you take the PHI, at fair value. That's one thing to be done. Second thing, before the acquisition entry is done, second thing, what you need to do before the acquisition entry is done, you revalue the investment debit, and the credit is given to the P&L or the OCI as the case may be. The credit will go to the P&L if it is FPTPL. The credit will go to the OCI if it is FPT-OCI. So you give a credit, the change in the fair value, to the P&L or the OCI. And you also need to remember that any accumulated OCI balance, let's ask you, with this understanding, any accumulated balance in OCI, are you going to put that in retained earnings or are you going to root it in the P&L? It's a case of OCI NR, there is no recycling. So where do you put it, friends? Are you going to put this directly in the RE? So are you going to put this in terms of RE or are you going to put this in the P&L? It's NR, no recycling, which means it's a direct shift from the tab 3 to the tab number 2. And that's rightly said. I think we have to get answers, maybe slow on that. So it's going to be simply transferred, you can say, to retained earnings directly. No routing in terms of the profit in this case, right? I think you got the picture. Secondly, when I am looking in terms of significant influence to control, immediately it comes to the mind that I am accounting under Ind AS 28, which is called an equity method of accounting. Immediately it should come to your mind that it is supposed to be a case of equity method of accounting. And in this particular case, what do you need to do? So in this particular case, number one, as a part of the PC, you're going to take the PHI. You're going to take the PHI at fair value. So you're going to consider the previously held investment at a fair value. And what you're going to do before acquisition accounting. Before you put the acquisition entry, so before the acquisition entry, now there are two things to be done. Now there are two things to be done before the acquisition accounting entry. Number one, you revalue the investment. So investment will be given a debit and P&L will be given a credit. So you need to revalue the investment. Here the revaluation went to P&L or OCI. Here the revaluation will always be a P&L. So gain or loss, whatever, enters the P&L. And what you need to do, scrutinize. All you need to do is scrutinize the OCI credits. You need to scrutinize the OCI credit, that because of the equity method of application, what is the amount in the OCI? So what you can do, that whatever amount is there in the OCI, you put that amount in the P&L if it relates to recycling. You put the amount to retained earnings if it relates to no recycling. Make a scrutiny that whatever amounts were given a credit in the OCI if it relates to recycling amount. Like for example, FCTR as per Ind AS 21, P&L. Like for example, if you say it is revaluation surplus, that is Ind AS 1638, then it's directly taken in retained earnings. And after this, you can comfortably pass the acquisition accounting entry. Wow. Okay, so I think so far so good. I guess you should be feeling very comfortable now in terms of the PHI. So I've done a discussion on 5 special issues to relate to PC. As I said in the previous class as well, that this is quite a technical area. It takes almost a class to cover the concept of purchase consideration, or slightly more as well. So we've done DC, CCE, CCS, TC, and PHI. Now let's get to the share-based payment. So let's see if any questions coming to your mind so far. Yes, Rahul, you said, so derecognition of the full investment or only changes are to be transferred to the retained earnings? Full. Whatever is the full amount is going to be transferred in the retained earnings or in the profit and loss. So we're not going to take any percentages. Whatever is the balance, we're simply going to transfer the entire balance in this case. Okay, so now with this inputs, let's take on further friends to you. I am now wanting to go to the next issue, that is a share-based payments, where I need to first create your thought processes. So let's, I think, first come to the thought processes with you. So let's get the thoughts clear to begin with. Okay, now watch this carefully. I know it's a, switch on, switch off becomes a little difficult, because the mind starts thinking of so many things. But let's, I think, get started and discuss about the share-based payments. I'll make a chart later, but let's first understand, some basic concept. In order to elaborate the concept of share-based payments, I'll take an example to illustrate the concept. Let's say there is a company A Limited, and let's say there is a company B Limited, and let's say there are employees of B Limited. Let's say there are employees of B Limited. Now let's say A Limited acquires a control over B, so A becomes the acquirer and B becomes the acquiree. Now let's take some figures to understand what is the thought processes of A. Let's consider that, for example, the company B has number of shares in the balance sheet. Let's say he's got a total of 1,000 shares in the balance sheet. And let us say A acquired a 60% control in the company. So he's basically acquired a total of 600 shares in the company. Now, B has also issued certain ESOPs to the employee. And these ESOPs will ultimately, the ESOPs which he has given is ultimately going to result in, let us say, a total of 500 shares being issued to the employees later. These ESOPs are something which is going to be converted, let's say, 3 years later. So let's say this ESOP is going to be converted at 3 years later. So let's get the position very clear. So there is a company A which today acquired a control over company B, and that is with a 60% stake. And the company B has also issued certain ESOP to the employees, which will ultimately lead to 500 shares being allotted to these particular employees. Now, A Limited will start fearing this transaction. Now see what is the thought process of A Limited. A Limited quickly makes some calculations in his mind. And he understands that once these 500 shares are given to the employee, this company will ultimately have a total of 1,500 shares. And then he starts making a calculation that I've got 600 shares out of 1500 shares, which means 600 divided by 1500. My stake in this particular case will get diluted from 60 to 40% because I'll be left with 600 shares and 1500 shares will be there in the company as a whole. So he knows very well in advance that once this ESOP gets converted into ordinary shares, then these shares will go to the employees of B and they will become the shareholders of the company B. And on the conversion of this ESOP to ordinary share, this fellow automatically will lose a control over the company. He would definitely fear that. So naturally, when he understands that the conversion of the ESOP into ordinary shares will dilute his percentage, he needs to do something that this doesn't happen in the future. So what does he do? He approaches the employees on the date of acquisition itself. He approaches the employees on the date of acquisition and he tells them on the date of acquisition that I will replace your share-based payments. This is called share-based payment awards. These are technically called awards. So he will say that, okay, what I'll do that, since you have been given ESOPs by the company B, forget about these ESOPs. I will give you new ESOPs in its place. He plans to replace these ESOPs. So when he plans to replace the ESOP, what happens that these employees will get shares not in B, but they will get shares in A. So A is able to retain 60% control in that company B, even after the employees will fulfill the conditions and these shares are given to them, they get shares in company A and not the shares in B. So the question arises that if A Limited is planning to replace the share-based payment awards to the employees of B, is it got a role in the acquisition accounting entry? Remember step 3B, where we said share-based payments to be discussed? And is it got a role to play in terms of purchase consideration or not? So first we got the thoughts correct. Because if I directly tell you that A Limited plans to replace the awards of employees, you will say, so why would he do that? What is the good point he's getting an advantage? The advantage is that if he doesn't do that, he knows that he's going to lose a control over B. In anticipating that he loses a control, he decides to replace the shares today. Now, as a part of the deal, it's not necessary that every time you plan to replace. Let's say today you've got almost, let's say 100% shares in the company. Even if 500 shares are given later, then you still get almost like a 2/3 stake. The control doesn't dilute. So it is completely the analysis of A Limited where he would decide he wants to make a replacement or not. So we can say in terms of share-based payments, there are going to be, you can say, 3 kinds of situations which can arise. So I would say there are 3 kinds of situations which could arise. Number 1, there is going to be something we can say is a mandatory. There is going to be something what we say is a mandatory replacement. I mean, he doesn't have a choice, but he has to replace these awards. He has to give the new awards to the employees of B Limited. He doesn't have a choice in this case. It's a mandatory replacement. The second situation is he decides that in this particular case, it's an optional replacement. I mean, it's not mandatory, but it is completely his option. He says, okay, I will replace, but it's not mandated for him. So it may be a compulsory replacement, or it may be an optional replacement where you feel, okay, I'll do that. Or he decides, sorry, there is going to be no replacement. So you can say broadly, there will be 2 cases. One is you can say he replaces, which can be mandatory or optional, or he decides not to replace. So we now need to understand the accounting treatment in all these 3 permutation combinations, that if he plans to replace these share-based payment awards, then what is the role of this, number 1, in terms of step number 3B, list of net assets? And what is the role in terms of the purchase consideration? We're going to first see the impact in terms of purchase consideration. I'm not worried on the list of net assets that will automatically get taken here. So, but we need to understand the concept of what is the role in the PSC, right? So I guess so far so good. You've been able to catch up with the concept, I believe. Okay. Okay, now that you said, so please repeat scrutinizing of the OCI point. Okay, I'll just do that. And Raul, you said that means 8850. Okay, that was related to the previous question. Okay. Let me just put that once again to you regarding the OCI scrutiny. You see, what I said in the PHI was that if you see that when the net assets of the associate went up, you did the entry investment to PNL or you did the entry investment to OCI. So let's get it very clear. As an investor, you would have taken investment to PNL or you would have taken investment to OCI. So there is a credit in the OCI in the books of investor. Due to equity method of accounting, there is a credit, you can say, in the books of the investor, right? In the OCI. Now, this credit which you took in the OCI could be OCI recycling, could be OCI no recycling. So which means what? When you are converting from a significant influence to control, you need to see what was the amount credited to OCI. Was it an amount which was relating to recycling? Or was it an amount related to no recycling? If the amount is related to recycling, what do you need to do? You need to put this amount in the P&L. So whatever amount was taken in the OCI and went to the tab number 3 in the books of the investor, and it was a case of no recycling, you need to put that in retained earnings directly. And whatever amount was related to recycling, you need to put it in the P&L in the future years. So we're going to put this in the P&L right now because it was taken to the OCI earlier, but now it is to be taken in the P&L. So scrutiny means you need to see that what was taken in the OCI. So was it R, then it should be P&L. If it is NR, then it should be retained earnings, right? Okay, I guess that answers your question. Okay. And Raul, you said that means 8850 will be transferred to retained earnings as per the last question on only 850. No, not 8850. It is only that figure of 150. As I said, 700, which you took in the P&L, that doesn't make a difference. When you did the entry investment to P&L, that is 700, that was already taken in tab 2. I know I'm not bothered on that 700. 8,000 was the initial cost, not bothered on that. 700 was taken a credit to the P&L, not bothered on that. My botheration is only the amount of 150, which was taken in the other comprehensive income. That was only to be scrutinized, that out of that 150, we saw 100 is an amount which is RNR, 50 is another amount which is RNR. I guess you got the point, right? Okay. Right, friends. So I think this takes care of the inputs and the introduction to the share-based payment as well. Okay, I think I'll not take it further at this stage, but I think I've just given you the basic inputs. Now, what do we need to do in the next session with you? That is tomorrow. I am going to discuss with you the concept of share-based payments. I've already given you the inputs that there are 3 permutation combinations which could arise. It could be a case of mandatory replacement, no replacements, or a case of optional replacement. So what is the role of these 3 situations in the calculation of PC? That's what we need to see in detail as well. And then there is a pre-existing relationship. Once we're done with these 2 points, we are done with acquisition accounting with you. Then I think we can pick up a full-fledged question with you tomorrow. And I think we should also be able to start with the concept of reverse acquisition as well. But I think common control transactions will be left over, which will carry forward again in the further sessions. So I think that seems to be quite good for the day. But friends, please do revise all what we've done. Let me see if you've got any questions further. Otherwise, all clear. That's wonderful indeed. So I think, friends, that's all for the day. But please remember, you need to do a cumulative revisions of the concept. So that's all for the day. So I think seems to be no further questions coming in. So thank you very much for the day, friends. And I'm going to see you back tomorrow again. Bye-bye. Thank you and take care. Thank you.